is where governments tend to go. That's not necessarily the story of China, of the government that we have there. It is more about trying to boost exports and not consumption. So we must re-educate ourselves with respect to that. I think that accounts for some of the impatience that we have, because we don't perhaps understand the different psychology in China. But this does affect so many other countries. China is the biggest consumer of commodities. It's a big export partner to Germany, and this definitely comes back to German weakness through that trade channel. If you look at factory orders, for instance, they appeared to be strong yesterday in Germany, but actually, if you remove aircraft, for instance, you still see a lot of weakness in the auto sector and other parts of the machinery production sector. So the weakness of China is coming back in various different channels.
The dollar China with a 7 handle used to mean something, Jane. That's where we are right now, and seemingly people more comfortable with that. Jane, what are you expecting to develop on the currency side of things?
Well, from our point of view, I think this will more dollar strength, and I think that is going to be a story that's going to carry on, like I say, until the Fed does start to cut interest rates. And at that point, there may be a little bit more interest in maybe EM, for instance, a little bit more interest in high yield. But of course, that very much depends on the broader outlook of the global economy. And China is part of that as well. But for now, I think the Chinese renminbi is on the back foot.
One thing that I try to do every morning as I read different headlines is try to parse the signal from the noise and what actually matters. And one thing that I hear increasingly in the noise are central bankers talking about the Red Sea and some of the potential inflationary pressures, particularly in Europe. Is that signal or is that noise for you?
I don't think anybody knows yet. The fact that we heard central bankers talking about this in Davos, and Lagarde mentioned it. We had Bailey talking about it in January. He mentioned it at a press conference. That's the Bank of England and the ECB, therefore, talking about this, and some others. And I think they're flagging it. But right now, we just don't know how much this is going to contribute. Now, certainly, if we look at shipping prices relative to where they were a couple of months ago, they've gone much higher. But we're still looking at nothing like the sort of situation that we had, after the pandemic. So for now, it's relatively moderate. But if this situation carries on for several months, then we could potentially be talking about another add-on to inflation. But right now, I would probably say it's more to do with reduced disinflation as added inflation, something subtle there, but right now, something to be concerned about, but nothing to panic about at the moment.
Hey, Jane, appreciate the update. Thank you. Jane Foley there of Rabobank with a 3-month target on euro-dollar of 1.05, questioning why maybe it should be even lower. You strip out the United States, the international story right now, Lisa. Not great at all.
Especially because you could even use the S word. I mean, it's almost stagflationary.
I thought you were thinking of a different S word then.
I was
Checking
not.
the clock.
No,
Just
come
surveillance
on.
after hours.
All right. No, I'm not going after hours. It's still the morning. Good morning.
Good morning.
Thank you. But, honestly, I'm just thinking about going forward, what this potentially could be if you're dealing with wages that are increasing, for example, in Europe, but you also see industrial output really coming down.
The other S word works too, for whatever it's worth, which is why I thought that's where you were ultimately going. Coming up on the programme in the next hour, Kelly Kaminsky of Alpha Simplex, Block co-founder Jim McAlvey. Look out for that. Fantastic conversation through the hour coming up. Terry Wiseman of Macquarie, Herman Chan of Bloomberg Intelligence with NYCB down in the pre-market. Once again, from New York City, equity futures just a touch negative here. We're down by 0.04% on the S&P 500. Last week, Meta had a massive move higher on earnings. This morning, Snap is getting absolutely battered in the pre-market, looking like a completely different company to the one ran by Mark Zuckerberg. From New York City this morning, good morning. The second hour of Bloomberg Surveillance up next.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of ON's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined ON as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Fed just can't give you what the markets want the Fed to give you.
If inflation does continue to behave as it's been, the committee is a little just struggling to catch up to how quickly the data have moved and what to make of that.
This idea that you can have stable or improving economic growth, but inflation continuing to decelerate, we just thought that was never credible.
Interest rates, while they're a dampener, aren't really able to offset that big moderation of inflation that we're seeing.
The inflation genie is not fitting back in the bottle.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P 500 totally unchanged. Let's work through some single names and start with Uber. Plenty of earnings out there this morning. Uber is doing okay. Lisa, better than expected.
People looking at fourth quarter earnings coming in, or bookings, I should say, coming in higher than expected. But I just want to note, this is their first annual profit for Uber since its IPO. And I wonder if this is a ride-hailing story or if this is a consolidation of the behemoth story, because Uber certainly is seeing growth that maybe some of the competitors are not.
That stock is unchanged. That looks boring. Let me show you a name that is anything but. Snap is down in the pre-market by more than 30%. We're talking about a third of the market cap gone in the pre-market. Unreal. Look at the numbers. We're talking about losses. We're talking about misses, Lisa. Nothing pretty about this everywhere you look.
Talking about ad revenue, which was the boon for the likes of Meta, which is interesting that you sort of juxtaposed Meta and the record gain that it had in market cap last week. They're talking about a challenging operating environment, particularly with ad revenues, talking about revenue increasing by 5%, missing the analyst projection. Also announcing another 10% reduction in staff to, quote, reduce hierarchy and promote in-person collaboration. Again, how much is this a Snap story and how much is this a macro story? How much is this a consolidation of all the business at Meta and maybe not at Snap?
Well, for some companies, the so-called tech session is not over. The recession of 2022 that we saw play out quite brutally for even some of the big cap names as well. For some names like Snap, it's not over.
It's not over, and they're still reducing staff. They're still trying to right size. The focus on getting back to the office I find fascinating.
Yeah.
Tech was talking about everyone can work remote, and suddenly not so much.
Well, that has implications for what we're about to talk about now, which is NYCB. So I'm sure you're all following this bank at home. In the pre-market, it's doing all right. It's negative about 3%. It hasn't been doing all right over the last week or so. We're talking about double-digit losses in the last 4 or 5 days or something like that, Lisa, which is just absolutely unbelievable. We've lost more than half the market cap since the end of January. And the get back to work, get back to the office theme, this is what's hurting them. Commercial real estate in a big way.
And it hasn't been fully repriced. And we're talking about zombies. I want to go back to Tony Dwyer's zombie idea, because really it's this question of when does it actually come to the fore, because everyone's been talking that this is going to be a problem. And yet now suddenly we're seeing it come out of the woodwork. That is what I think is spooking people. The idea that we knew that this was an issue, and now suddenly it's become something more imminent.
For Secretary Janet Yellen as well. So yesterday on Capitol Hill in front of the House Financial Services Committee, I believe tomorrow, Anne-Marie, in front of the Senate Banking Committee, becoming a bigger and bigger issue down in Washington.
I imagine she's going to get asked specifically about this again tomorrow, because she didn't want to comment on a single name, but she did say there is concerns in this sector, and she pointed to the supervisors. She said they need careful attention when it comes to supervisory, but we are aware that this could create financial stability risk or losses in the banking system.
What else can she say?
Exactly what you took the words out of my mouth. I mean, honestly, she can't be like, this isn't a problem. And she can't say this is Armageddon. It's sort of, we're carefully watching it. Trust us.
It's the lesson of last year, and we mentioned this in the last week or so. The lesson of last year wasn't a lack of regulation. It was poorly executed supervision. And I think what's interesting about our reporting so far this week is basically the regulator was leaning on the specific bank, according to our reporting, to do something about things and do something about it fast, which is not what we saw last year.
The fallout, though, is similar, which is interesting, because even though regulators were on them to do something, it hasn't stemmed some of the losses, but maybe it has given people confidence that they have some supervision. We heard that from Jay Powell over the weekend, too. They're working with a number of banks. So everyone's saying, okay, who else? What does it rhyme like?
What are the names? Yeah. NYCB is one of them, down by about 2.86% in the pre-market, much better than where it was a little bit earlier this morning. The broader market, in the equity market at the moment on the S&P 500, futures look like this. We're negative, but only down by 0.07%. In the bond market, yields are higher by 3 basis points, 412.88. Lisa wants this on repeat. 10-year notes come today, $42 billion worth. Lisa, tomorrow, $25 billion of 30-year bonds.
And I caveat this with, it's not going to matter unless it does, right? I mean, it's sort of talking about Yogi Berra quotes, but this is a sort of thing where if it gets messy, then people will start to talk about debt sustainability. And if it goes well, people will say debt sustainability is not in anyone's mind.
It mattered in October, not so much now, apparently. But that can change quickly.
Exactly.
That can change quickly, and it changed quickly based on just Treasury Secretary Janet Yellen saying, yeah, less longer-dated debt than you thought, than you expected.
And so what could shift the sentiment? There's really a question of how quickly can this change in a dime, and then how self-fulfilling could it be, given that sentiment begets sentiment and that people tend to get worked up because nobody really can follow the narrative at a time of deep uncertainty.
You don't sound frustrated at all. The 2 years up by a single basis point. The 2-year right now, 4.42. Coming up this hour, Katie Kaminsky of Alpha Simplex as the Fed urges patience on rate cuts. Jim McKelvey, co-founder of Block on banking regulation. Terry Wiseman of Macquarie on U.S. exceptionalism. All of that and more still to come. We begin with our top story this hour. Fed officials continuing to push back against early rate cuts. Cleveland Fed President Loretta Mester saying this, quote, "It would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. So is long fixed income still the new short?" Joining us now for more is Katie Kaminsky of Alpha Simplex. So Katie, that's your line. Long is the new short. Is that still the case?
Yes, it is. And I think the biggest issue for me is that we have not been in position similar to a soft landing for 2 years. And now suddenly technical signals are agreeing with a soft landing narrative. Is this hope, or is this potentially something to worry about? That's what I'm thinking about right now.
How does that jive with what we've seen in the data Friday and again on Monday?
Well, I mean, if you look at fixed income, it's kind of in a holding pattern. There's definitely buying pressure, which is being pushed off for this huge hopes for cuts. So people are thinking we need to get in now before we get the cuts. But as you see from the policy speak, there is no hurry for cuts anytime soon. And so as a result, fixed income is sort of floundering back and forth between it's time to be long, but at the same time, it's going to take more time for cuts than people would like.
Katie, how much do you care about auctions?
We care a little bit, but it's exactly like you said. I mean, it's really a no op unless something really happens. And it is something that is a risk for the long end of the curve. If we are going to see continued higher for longer rates for a longer period of time, should we see that weakness in the long end of the curve, we might see the steepener without the cuts. So I think that's why people are watching it, just to see if that could show signs of some fragility in the system.
I was talking earlier about how I feel like it's deja vu all over again. We kind of feel like Back to the Future with this idea of, the no landing or soft landing and what we're going to do with a reaccelerating U.S. economy. If the Fed remains on hold for longer and isn't so quick to cut, does that give you more conviction or less conviction with the long bond call?
Well, I think bonds have gone through their cycle. We've seen an inversion. We've seen a flattening. And frankly, the next step is a steeper yield curve. And so if we do stay higher for longer, then, it could be weakness in the long end of the curve where people kind of lose some faith, which you have to watch for. I think for us, the biggest thing that is a concern is if you have upside risk in inflation that people are really hoping against. That's something that I think we worry about for this year.
So, Katie, let's drill deeper. Let's go through some scenario analysis. We've been trying to figure out around the table whether good news is good news for stocks. So we've been looking at the reaction in the bond market, strong data, high yields. Then we'll go to the equity market. Friday, we were okay. Monday, not so much. So, Katie, I'm trying to work out how that bond-stock correlation has been developing over the last few weeks off the back of these upside surprises.
So I think the biggest thing for us, going into what you're saying, is that everything isn't the same as it used to be. We're still seeing positive stock bond correlation, which is consistent with inflation still being a key theme. And we're also seeing heightened bond volatility, which is also suggesting that people are very uncertain about the direction of fixed income going forward. This is not consistent with a soft landing, we're there narrative. So I think that's something to watch because it's something that indicates that asset prices are still really focused on inflation.
Is this consistent with a stronger U.S. currency?
Well, I think the challenge here, and I think I want to point this out, this is something we're talking about right now, is the biggest challenge is going to be the role of China in this entire narrative. If you look at China and the BCOM, they have moved hand in hand. So the question you might ask yourself is, should China come back online? How many of these stories are going to kind of turn the other direction? China is a major player in terms of raw commodities, which often lead the pack when we come to inflation kind of roaring back. So I think that's what I'm interested in this year is what happens in China and what is its role in commodity prices that could be sort of a huge factor that we're not thinking about.
Which brings us full circle back to the idea that asset prices, and you are very focused on inflation, the potential risk of a reacceleration. Do stocks hold in that case? That seems to be what a lot of people are saying, is that stocks are a better bet right now than bonds or cash, should we get that inflation surprise?
Well, think about it. I agree, because when you have an inflation surprise, it goes straight to bonds. Those are long-term cash flows. Inflation, especially in the short run, isn't so bad for equity markets. I think the challenge is when you hit more restrictive financial conditions, which frankly, the data is not suggesting yet. And so as a result, equities are still looking relatively good, and the U.S. is really looking ahead of other regions. So I think that I would agree with that.
U.S. exceptionalism is a theme all over again. Katie, thank you. Katie Kaminsky of Alpha Simplex. We'll catch up with Terry Wiseman of Macquarie about that later this hour. Your equity market on the S&P 500 is totally unchanged. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Online talk show host Tucker Carlson has interviewed Russian President Vladimir Putin. The former Fox News anchor was spotted in Moscow in recent days. The interview is Putin's first conversation with Western media since the beginning of the Russian invasion of Ukraine. Carlson says he also intends to interview Ukrainian President Volodymyr Zelensky. Shares of Snap plunging in the pre-market trade this morning following disappointing revenue from holiday quarters. Fourth quarter revenue came in at $1.36 billion. That missed analyst projections of $1.38 billion. The parent company of Snapchat has been restructuring over the past 2 years and announced that they'll cut workforces by another 10%. Nearly 68 million Americans are expected to place a bet on this year's Super Bowl. That's according to the Gambling Industry's National Trade Association. And that's a 35% jump from last year. The total value of bets is estimated to surpass $23 billion, but of that, just $1.5 billion is projected to be with legal outlets. Sunday's Super Bowl pits the Kansas City Chiefs against the San Francisco 49ers. And that's your Bloomberg Brief. John.
That stat's amazing. Not the 68 one, the other one. Danny, thanks for that. That's phenomenal, just to hear those numbers.
Yeah, but how much of that is like squares and things like that? People kind of betting across the table versus real kind of formal illegal bets.
Are we going to do our own bet here?
You want to bet now?
To be honest, I don't know anything about these teams, so no.
Okay, so the answer to that is no. We can do that in a commercial break if you want, like for $1 or something like that. Up next on this program, Treasury Secretary Janet Yellen on Capitol Hill.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
That conversation up next. This is Bloomberg. Live from New York City this morning. Good morning to you all. The equity market on the S&P 500 slightly lower by 0.04%. Yields are higher by 2 or 3 basis points on a 10-year 412.88. Under surveillance this morning, Treasury Secretary Janet Yellen on Capitol Hill.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
Here's the latest this morning. Yellen voicing concern over losses in commercial real estate, stopping short of commenting on a single institution. This as Moody's cuts New York Community Bank Corp to junk, and shares hit their lowest level since 1997. Herman Chan, senior U.S. regional bank analyst at Bloomberg Intelligence, joins us now for more. Herman, is this the worst of it, or is there still more to come?
Look, there's probably still more to come in terms of what's going to happen next with New York Community Bank and then for the broader regional peers that do have exposure to areas of concern like commercial real estate. So the story's not over yet, and we're bracing for some more bumps in the road.
Herman, do you have a sense of how many banks the Federal Reserve is talking with right now and trying to oversee, as well as the Treasury, as we heard from Janet Yellen yesterday?
Yeah, I think the banks that really have higher exposure to commercial real estate, there's a regulatory ratio that's been discussed about 300% of commercial real estate as a percentage of your total capital. And there's also another regulatory marker, 100% of construction lending as a percentage of total capital. So banks that clear that metric may have higher regulatory scrutiny in this current environment.
The good news is that NYCB is down 5%. Herman Chan at Bloomberg Intelligence. Now, I say that's good news because yesterday we were down by 22%, Lisa. The day before we were down by almost 11%.
So basically, this is what, a revival, because it's only down 5%. This is stabilization at $4 a share.
Down double digits Thursday, down double digits Wednesday. We've lost more than half the market cap of this bank in just about a week.
Which raises this question of, okay, first of all, can it continue? Does this really jeopardize some of the relationships? When you have to come out and say this doesn't jeopardize a relationship, it's not a good thing to hear. But then also, how far does this go when you see the KBW index of regional bank stocks down 11% since January 29th.
I think we've all been excited for this conversation all morning. Joining us around the table is Jim McCalvey, the co-founder of Block and former chairman of the board of the St. Louis Fed, joining us around the table for the rest of this hour. Good morning, sir.
Thank you.
Good to see you, Jim.
Yeah, it's going to be a lot of fun.
We're going to have a lot of fun right now. Maybe not on this topic, though.
Let's start with the gloom.
Let's talk about the stress in the regional banking sector. Your thoughts on last year, which seemed to be rate stress. This year, is it going to be the year of credit stress?
Well, I mean, everyone was worried about the banks because there's such a concentration in commercial lending. And commercial real estate isn't worth what it used to be because people aren't going into the office. But the good news is, and at the last Fed meeting that I was in Washington, D.C., we discussed this. The good news is it's a problem, but it's not a surprise. So everybody saw this coming. So it's baked into the rates. And you're seeing it play out in the numbers right now. We're discussing that. But this isn't going to come as some pandemic-like surprise where all of a sudden it knocks the world economy over because we didn't see it coming.
It begs the question why some of these banks hadn't already provisioned for it.
Well,
NYCB came out in the last week and did just that.
Well, it was a crash. I mean, the pandemic hit, people stopped going to the office, you had these long-term commitments, these mortgages, and that doesn't unwind instantly. So you can't get out of it. It's a game of musical chairs. I mean, you're stuck with it. You know you're stuck with it. Everybody knows you're stuck with it. So you can't just dump it on some other sucker.
Well, so as someone
SoftBank is stuck,
yes,
right?
well, I mean, we could discuss.
We can talk about that.
Yeah, we had a lot of fun with that. We miss you. We miss those days.
We can talk about Adam Newman going back to WeWork, but I am curious.
I guess you know.
But I'm just curious. When you take a step back, whether some of the disruption in some of the models makes it more difficult to sufficiently understand the risk. We're talking about, for example, SVB. I'm thinking about some of these other banks in terms of concentration, in terms of just their concentrations of particular asset classes?
Yeah, so the models have been, sort of slow to respond. But, I mean, if you look at it, the system really performed quite well during the SVB situation because the SVB was sort of a weird bank. It had this very weird concentration of behaviors and deposits and this sort of niche-y thing in Silicon Valley. And when it blew up, the system reacted so quickly and so well. And there was a question, were we going to, bail out uninsured depositors? And the answer, internally, which we all knew, of course we were, because it's the regulated financial systems. You can contrast that with an unregulated system, like what happened with FTX. There was, again, a problem, but there was no regulation. There was nobody in there to, sort of, no adult in the room. I mean, I think literally. And it collapsed, and people got wiped out. So, what I look at is, sort of systemic risk. And the FTX disaster was a disaster, but it sort of proved that the model worked. Now, could we regulate better? Yes. Should we? Absolutely. And we're changing the models. But, I was on the Fed at the time, and if you watched how the Fed, the FDIC, and the Treasury all responded in, in real time to a problem, it was very comforting.
Well, so you've been on all sides of this, which I love.
Yes.
Because you've helped, you founded Block, and you also have seen it from the regulatory standpoint. You talked about SoftBank. We're talking about zombies. How many bad actors are there left who haven't been exposed in some of sort of the new finance?
Lots. There are always lots of them. The bad actors. Look, it's not some sort of thing like we extinguish it. These people move from thing to thing, and a lot of them get to find the next thing. I don't know what it is. I'm sure there's going to be a lot of fraud in AI. I'm assuming there's going to be a lot of fraud. There was tremendous amount of fraud in advertising. So we just saw what happened with Snap and Bloomberg. And advertising for years was this just total cesspool of unregulated fraud. And it's still going on right now. That's why companies like Bloomberg are so amazing, because you guys actually are a solid, fact-creating, fact-reporting company. Whereas most of them, you look at what's happening with Dow Jones, look at what's happening, sort of the news world, it's just imploding.
Because of AI. And you think there needs to be actual regulation for that?
No, it's not. It's not AI that's killing news. It's the fact that, basically the platforms have hoovered up all the ad money. Yeah, Bloomberg being the exception.
How are we going to confront an era of disinformation, the potential of that coming from AI in the years to come? What's the best way of doing that?
Nobody knows right now. I mean, I think in the world of AI, we absolutely need to start thinking about regulation quickly, and not just, sort of government regulation. I think what we need is a market of regulation. So in other words, we want to have for-profit companies that are monitoring artificial intelligence developments. Much in the way we have Underwriters Laboratories, certifies, probably this keyboard has a UL listing on it.
So since you've been on all sides, I love that you've been on the government side, you've also been on the innovation side. There's been this sort of angst that governments can't pay enough to get the talent to actually counter some of the AI threats and get ahead of them in any real way. Do you pay credence to that kind of idea?
We can pay enough. It turns out you don't actually have to pay top dollar, because, when I was at the Fed, like the Fed has a cap, we're basically not allowed to pay much more than the president earns to hire people. So we were hiring people and paying them a quarter or a tenth of what their market rate would be. But there's some people who will work that way. Like, there are a lot of actually excellent people who come in and do that. So it's not just a question of throwing dollars at a problem to solve it.
We see that at the Federal Reserve. I think you can earn more as a regional bank president, say on San Francisco, for instance, than you can as a governor of the board of the Federal Reserve, which is kind of nuts.
Yeah, I mean, when Chris Waller moved to D.C., like, it was...
Took a pay cut, didn't he?
Oh, no, well, not much of a pay cut, because he was already working for the Fed in St. Louis. But, I mean, the poor guy couldn't afford housing. Like, this is in D.C. This is a real problem. So I think we should allow the government entities to pay more. I think that would be a good thing, that we shouldn't have this artificial salary cap, because it is hurting. I want to set up the next segment with you as well, Jim, because you're going to be sticking around with us. I've always wanted to ask you this. Why the banks here in America didn't create block? How they missed this? How did that happen? So, I mean, I read an entire book on this. It's called The Innovation Stack, which I shouldn't promote it because it was published 3 years ago. I published it during the pandemic, so nobody wanted to read about it. But look, if you think about the world of innovation, the truly transformative innovation always happens outside of the market. Because what the market does, the market fills its space, and it says, okay, we are going to serve people down to this level. And when Block started, which we used to call Square, when Square started, the ability for small merchants to transact using the same tools that the big guys had wasn't there. And so we built an entire system underneath what the market at the time was. And as a result, millions of little businesses were able to then, have the tools so they could take payments and they could do their payroll. Like, they had, we gave them all these tools. But that, by definition, never happens from within the industry. So, my research for the book basically showed this pattern again and again. So the same thing happened, great example would be airlines, okay? So at the time, before Southwest Airlines, airlines were basically the tool of the rich. Like, you could travel in an airplane if you were rich or if somebody else was paying for it. But normal people took the bus. And Southwest Airlines basically invented what we now think of as air travel because they made it cheap. They made it, affordable to everybody. And that innovation never comes from within the industry. So the banking industry, as it existed in 2009 when we started Square, was never going to do what we did.
We're going to keep talking about it. I also want to know if you take any blame for what happens now when you go to get a coffee and they flip the screen around and...
Yes,
I'm wondering if you actually take responsibility for that, Jim. Jim McAlfee's going to stick with us from New York. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocks on the S&P 500 going nowhere, totally unchanged. Equity futures this morning look like this. We're positive 0.08% on the NASDAQ 100. On the Russell, the small caps rock bottom in yesterday's session. The financials this morning down another 0.5%. We'll talk about NYCB a little bit later. Let's turn to the bond market. 2-year, 10-year, 30-year. Plenty of supply coming a little bit later. I've talked about the 10-year issue. $42 billion of 10-year notes coming later. $25 billion of 30-year bonds coming tomorrow. Your 30-year this morning is up 3 basis points to 4.33. Lisa, up 3 basis points on a 10-year to 4.12.69.
I'm watching the auctions to see whether there's something that comes to the fore that's a little bit less positive than yesterday, in particular because longer-term inflation expectations are starting to creep up as we get this better than expected data. And it raises this question, when does that start getting priced in addition to deficit issues and sort of the risk premium that people talk about?
That's the bond market. Here's foreign exchange. Jane Foley speaking to Lisa, Anne-Marie and me a little bit earlier of Rabobank on euro dollar looking for 1.05 in the next 3 months or so. We're at 107.70. The real question right now, Lisa, is why not lower than that? Why not parity all over again based on what the data looks like in America versus what the data looks like over in Europe at the moment?
Does this thing ever move that much? I mean, I think that maybe that's a reason why.
We've had a breakdown from 110, haven't we, to 107?
Exactly. It's been shocking for a couple of months. But here's the question, right? Essentially, because there is this big divergence with the U.S. outperforming Europe, when does that start to play out a little bit more in a predictable manner in
the euro
currency?
Just a touch stronger. Is that enough price action for you?
Fantastic.
Just a little bit. Under surveillance this morning, your top stories. Your first one, Secretary of State Antony Blinken heading to Israel with a peace deal building. Qatar saying Hamas gave a, quote, positive response to a proposal which would see a pause in fighting and the release of some hostages. Blinken saying the US is studying the Hamas response and has shared it with Israel. Anne-Marie, we've been closer and closer over the last week. How close are we?
Well, Biden yesterday, when he came out to talk about the collapse of this border deal and was asked about this Hamas ceasefire potentially, says there's been some movement, but then he said their response was a little bit over the top. What does that mean? What did Hamas ask for that the president said was a little bit over the top? And then how does Blinken, his 5th visit to the Gulf, to the Middle East, he's in Israel today, how does he sell this to the Israelis when you have Netanyahu saying basically that they are not going to stop until it's total victory in terms of crushing Hamas?
The 5th visit in about 4 months and likely, sadly, not going to be his last either. Let's turn to this story. Every time I do Boeing, I do give a warning. If you're flying this morning, turn the volume down a little bit. Just for a moment. 4 bolts were missing from the panel that blew out on the Alaska Airlines flight last month. This is nuts. According to US investigators, photos from a preliminary report by the National Transportation Safety Board suggest the bolts were removed at Boeing's factory and not replaced. In a statement, Boeing CEO Dave Calhoun saying, quote, whatever final conclusions are reached, Boeing is accountable for what happened. I mean, Lisa, where to begin with this story? Where to end?
I don't want to have to look at what plane I'm flying, and yet that's where I've started to look. But I just, again, bolts not being put in is not something that you want to hear, and it raises this question about the duopoly. You can't get away from Boeing, so what do they do to try to shore up their production?
Well, I was actually on one of these Boeing flights on Alaska, went back, and it was one of those flights. I just hope it wasn't one of those that was missing these 4 bolts. Wall Street Journal this morning, FAA keeps trying and failing to fix Boeing. Is it a Boeing problem, or does the FAA need to get more involved? Which, they were on Capitol Hill for grilling yesterday.
Jim, I've got a feeling you want to jump in on this story. What have you made of this?
Wear your seatbelt. I mean, look, the FAA does a really good job, but they've got a problem, which is there's one manufacturer. I mean, we used to have Lockheed, we used to have McDonnell Douglas, we used to have Boeing, and they would compete, and that competition has now been sort of sucked out of the market. You've got Boeing versus Airbus, but Airbus is this sort of weird, sort of state-sponsored weird thing. They both build good planes. So Boeing, they're solid planes. The planes are safe. But, fundamentally, they've got some management problems, and their president basically just said, oops.
Why isn't there more innovation in this sphere? Why can't we have something that breaks out from a duopoly where suddenly another player kind of challenges this?
It's the economics of building large planes. There's so much regulation, there's so much capital required that you just can't stand up one of these things. Now, the Chinese may be able to do that, but I wouldn't jump on one of their planes anytime soon. The Brazilians are actually building some pretty decent planes. And then the private market actually builds, sort of interesting experimental aircraft.
Yeah.
What the cool thing is that, at least in the United States, we have this thing that allows you to fly anything as long as it's written experimental on the side. So if you go to the EAA, you can literally, like literally, we could put balloons on this chair and legally fly it in certain
Just so long
areas.
as we write experimental.
As long as you put experimental on it, it's safe. And so it's actually a really good system for innovation because you'll see a lot of really cool things like, basically drones that you can fly now. And they're all over the skies. They're just not things that you would buy a commercial ticket
Just so long as it's not a plane made in China with experimental written on.
Yeah, you don't want to, I don't know what the Chinese word for experimental is, but it's probably tattooed on somebody's neck these days.
Let's not go there. Let's not go there. A game-changing moment for sports streaming. Let's go there. Disney's ESPN, Fox, and Warner Brothers Discovery are joining forces to launch a streaming platform. The service aiming to attract viewers that don't subscribe to a pay TV package, but offering them all of the sports that would be included, from the NFL to college basketball. The unnamed service is set to launch by the fall. We don't have a price either, Lisa, but Geetha Raghunathan of Bloomberg Intelligence suggesting something like $40 a month.
But to me, this really raises the question about whether the new disruption is going back to the old. I keep thinking, what is the new model for entertainment? I'd love to actually hear Jim's thoughts on this. What's the new model for entertainment at a time where streaming is kind of coming full circle and there are these disparate services, and how do you consolidate enough eyeballs and capital to really make it work?
Jim, thoughts?
So there are only 3 models that pay for content. There's subscription, there's advertising, and then there's pay-per-view. And we've never really gotten pay-per-view working well. I spent the last 6 years building something called Invisibly, which allows you to basically sell your eyeballs on your terms and buy piecemeal whatever you want. So you can get the Wall Street Journal, you can get the Atlantic, you can get, but right now all we have is news. All we have is news and journalism, print journalism, which it turns out most people don't want. They just, we handed it to them, and not a lot of people were eating from the buffet. But I think eventually what we're going to have is a system where if you want to see the game, you have access to the game, and some intelligent agent, some basically a robot that works for you will say, oh, Lisa wants to watch this, so she'll pay 30 cents to see this game, and then the money will flow and everyone will get paid. And that's ultimately, I think, the solution to this, because it's bundling and unbundling and signing up, and where's the game, and I have to sign up for Peacock in order to watch the Kansas City Chiefs and see if Taylor Swift showed up.
I feel your pain.
Yeah, it's nuts, and it's frustrating. But we're in this world right now where these are all things being worked out.
Let's go to the data that you have access to and how it enables you to make some political predictions. What kind of predictions are you making at the moment?
So Invisibly has a political polling arm that weirdly has been calling the elections correctly. So we called the Trump-Clinton, the Trump-Clinton election correctly. We called the last ones. The data right now is really interesting. The Democrats are likely to run the only person who could lose to Trump. And the Republicans are about to run the only person who could lose to Biden. And if either side would pick a different candidate, at least from what we've seen, they would win. But it looks like we're going to have this really weird standoff of, sort of the statistically least likely candidate in both sides.
What is the data telling you, and who would win this rematch?
Right now, Trump. Yeah, that's that. I mean, but it looks so early to tell. And look.
And what's the spread?
it's too close to call. I mean, it's, a couple of points. It's because what happens is you have these weird voters who don't respond to polling correctly. And one of the ways that Invisibly gets decent polling is we troll the worst parts of the internet. Like our ads run in the places that nobody admits they go. We get all that data. And it turns out that accurately predicted the elections in the past. So we hope it's going to still work.
So when Quinnipiac call up, people aren't honest with them. Is that basically what we're finding?
Yes. If I stand there with a clipboard and I say, John, who are you going to vote with? You tell me.
Here for Bloomberg Morning Consult, and we're not telling the truth. Is that basically?
No, but you just had the conversation with the cameras off. We had a very frank conversation, which none of you guys got to hear. This is the fact. When you poll somebody as controversial as Donald Trump, a lot of people tell you what they think you want to hear, and they don't honestly answer. So we get them where they really are, and they answer honestly. And that's
honestly, what are the worst parts of the internet? I mean, there's a lot of bad. That's pretty
there's
obvious.
so much.
Right.
There's so much.
Right.
You really wanted to go there. I wasn't trying to go there.
All right, fair.
I think we saw a similar
I forgot to think it's called surveillance.
I think we saw a similar thing with Brexit back in 2016. People were polled, and it was the difference between a telephone interview versus an in-person polling and all of that stuff as well. Is that what you're finding then?
Yeah, what we find is that if you ask them the question on the page and you don't pull them off the page so that they trigger into this, I need to answer correctly, then, or I should say honestly, they will answer honestly if you don't disturb them from the cat videos or people of Walmart or whatever else they're doing.
This brings up quite a philosophical question. It's who monopolized the moral high ground for the public to believe there was an answer to the question that you wanted, and the answer they did have, they felt like they had to keep in private. And it makes me wonder whether we've sort of lost where the country is actually in reality, and that the leadership is out there trying to please maybe the fringes of society without really directing it down the middle. Have we lost track of where this country is?
We have, I think, because a lot of the leadership is on the coasts, and a lot of the energy is in the Midwest and in farm states and in places where, normal people feel like they don't have a voice. And I live in St. Louis, Missouri. I'm from St. Louis, and this is the spirit out there. And I've watched this develop over the last 15, 20 years. We're not properly connected to the center part of the country.
We've already seen AI play out in this election, deep fakes on people's voices. How concerned are you about that?
Terrified. I'm just absolutely terrified and impressed, like it's gotten really cool. But
spoken like a true innovator.
Impressed because it's so good, and that is scary.
It's fantastic, and it's going to be the tool that changes lives and changes the way we work and changes the way we think. But right now, it is so dangerous to use the old system. So we used to say, if you had something that was typed, it was legit because it cost money to have a printing press. So if it was handwritten, it was possibly fake, but you couldn't fake type. And then we got laser printers, so everybody could fake type, and then we got the internet, so everyone could fake news, and now we have AI, so anyone can fake video. Like, I might not be saying this.
He is. Thanks, Anne-Marie. Well, I want to go back to something you were talking about with this sort of disenchantment, the point that John was making about the gap between leaders and the populace, and what you make if you sort of dovetail that to the economic picture, where the overall economic data seems to suggest real strength. And then you talk to people, and they don't feel good. And everyone's been trying to figure out this dissonance and say, well, maybe it's just because it takes time for inflation to come in. What do you make of it?
I think there's a lot of accentuating the negative in news because the news cycle has to get eyeballs, and eyeballs are going to come to you if you make people hysterical. And you do that again and again on a 24-hour cycle. And people eventually start to get depressed and start to think that their system is, being attacked. And then you've got the, sort of siloization of information where, you get your information from the sources that you want to. And then the algorithms, this is, what YouTube is famous for. The algorithms will serve you the stuff that makes you the most engaged. And engaged is pretty much enraged. So if I can piss you off, then you're going to give me your attention. I will take that attention. I will sell it. And that's really unhealthy. And that, at scale, gives us this tremendous division that we're seeing right now. And I think the solution for that is for us to take control of our eyeballs, by essentially having AI or intelligent agents working on our behalf, sort of pulling from the news sources as opposed to having it shoved down our throats.
Jim, you're going to stick with us, I'm pleased to say. I've got to squeeze this in, though. Are you single-handedly responsible for tipping culture going absolutely insane in the United States of America?
Not single-handedly, but we had a big part of it. I mean,
it's amazing what's happened.
And I will tip you for asking me that question.
Are you proud of it?
I don't have Block with me, but you know, I'd flip the screen and select 20%.
I don't think he's ashamed. I think you're proud of it.
No. Look, you have a whole class of workers that weren't being appreciated, and I think we gave them a way to express appreciation. And has it gone too far? Sure, because everybody's copied what we were doing, you know. But is it appropriate that we treat the people who serve us well? Yes, I think it is, and I think they've been unappreciated for a long time.
Couldn't agree more, Jim. You're going to stick with us. Thank you, sir. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. PIMCO says the Bank of Japan may scrap its negative interest rate policy as soon as March and hike multiple times this year. The firm predicts the central bank will raise its benchmark rate to 0% in April or March before hiking by a quarter point by the year's end. PIMCO says quickening wage growth will likely create persistent inflation, allowing the BOJ to exit negative rates. House Republicans are vowing to bring back articles of impeachment for Homeland Security Secretary Alejandro Mayorkas to the floor. The initial vote failed 214 to 216 after 4 GOP members sided with Democrats. But the Republican majority expects to hold another vote once House Speaker Steve Scalise returns from cancer treatments. Republicans charged Mayorkas with refusal to enforce immigration laws and failing to secure the border. Donald Trump, meanwhile, has been denied immunity in his case surrounding the efforts to overturn the 2020 election. He attempted to claim that a sitting or former president is immune from criminal charges. The ruling was unanimous from a Washington, D.C. federal appeals court and now moves Trump closer to the possibility of facing a trial ahead of November's election. The Republican frontrunner has until Feb 12th to appeal the ruling to the Supreme Court. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, another round of U.S. exceptionalism.
We are seeing a difference in outlook. The growth position in Europe is weaker. You know, we've seen stronger growth in the US.
That conversation coming up next from New York. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Stocks on the S&P 500 doing okay here, positive by 0.1%. If you're following the fate of NYCB in the pre-market, that stock is now higher by around about 10%, 462 in the pre-market right now. Under surveillance this morning, another round of US exceptionalism.
we are seeing a difference in outlook. The growth position in Europe is weaker. We've seen stronger growth in the US, and the European economies have taken a much bigger hit on inflation because of their exposure through the energy price. So, they've had a more difficult, challenging period over the last couple of years, and the growth outlook is a bit weaker, including because of actually an aging workforce in the euro area as well compared to the US, where we've seen some remarkable strength in the last couple of years.
Here's the latest this morning. US economic data continuing to surprise to the upside. Macquarie's Terry Wiseman writing this. When and if the US is no longer surprising positively versus the rest of the world, the dollar will weaken. For now, over the last week, the dollar has been stronger. Terry joins us around the table for more. Morning, Terry.
Good morning, John.
Any reason to believe this won't continue? Just how good are things in the States and how bad are they everywhere else?
Things are pretty good in the States, and but you can point to a few excesses in the States as well. And when we look forward, I think as economists, we should ask ourselves, where are the excesses and can they last? I'll point out one. The personal savings rate in the U.S. is 3.7% as per the last month of data. That's low compared to historic norms. We're used to having in the United States a savings rate that is, around 5%. And just prior to the pandemic, we had a savings rate of 7%. Are people saving enough for retirement? Probably not. Are they going to wake up to this fact? At some point, they might. At that point, they're going to start to reduce their consumption. And at that point, we might see that consumption-driven slowdown. Has it happened yet? Absolutely not. And it's very difficult to predict when it's going to happen. You can make a case that it can happen organically. People just wake up and say, hey, I'm not saving enough. Or they're shocked into saving more. It could be a stock market crash. It could be a sense from just reading the headlines that there's a problem in the commercial real estate sector. Something might cause that. When that happens, you'll see the economy slow, but it doesn't have to happen in the next few months. There's nothing that is militating for that to happen immediately.
It feels like we're putting a bunch of previous years on repeat this year. And I was just thinking that all morning. I feel like the same stories are coming up again and again, and this is one of them. Soft landing, no landing, we can just push it out. We're gonna get the weakness, it's just gonna happen later. How do you sort of factor in some of the data that's highlighting a lot more strength than people expected into this? It's gonna come, just wait, you'll see.
Look, some people are momentum people. They look at a trend and they simply extrapolate it. I'm not that kind of person. I don't care about the past, I just care about the future. But there's some validity to saying that, hey, if things are going well, they're just gonna continue to do so because, on a short-term basis, that usually works. And if all you have to do is predict what's gonna happen in the next month or two, then saying, look, the economy's strong, gonna be strong in the next 2 months because it's strong today is not a bad approach, okay? Given that the probability of these shocks coming in any given month is low, okay? But when you extend the horizon to a year or two, well, that probably goes up, okay? And it all depends on what your investment horizon is. If it's 1 or 2 months, yeah, probably nothing's gonna happen. If it's a year, you've got these worries, right? Is the personal savings rate gonna stay as low as it is? More importantly, are we gonna have a problem in commercial real estate, right? That's the other excess.
There's plenty. Terry Wiseman of Macquarie around the table with us, together with Block co-founder Jim McCalvey. Jim, you're affiliated with Emerson Electric as well.
Yeah, I just joined the board last June.
What are you finding they're telling you about the global economy right now?
So normally I'm not allowed to share this, but we just released earnings like an hour before this program started. So I bring to you good news from the world economy. So this is really cool. Emerson Electric, nobody's heard of them, but they've been around for over 100 years, and they make the stuff that makes the stuff. So they make valves and control systems and industrial automation. So if you're building a plant anywhere in the world, you're probably using Emerson equipment. So their sales basically show us if the world is optimistic. And I have the numbers here, hot off the press. America's up 8%, Asia and MEA up 15%, Europe up 10%. It's up worldwide. And we have not seen something like this in many years. Now, part of this is just Emerson's a pretty well-run company, so these are their numbers. So you have to take out these sort of well-run part of Emerson. But even if you just look at the broad sectors, the world economy is doing really well. And so this is data that I think it should be very encouraging for everybody, because the world economy is really the thing that keeps us all together as a planet. And if everyone's making money, we don't have as many wars, we don't have as much problems. And this is very, very good news. It just came out.
Terry, does that make you feel good?
It does, but at the same time, I have to wonder about what the role of China is going to be in this story this year. There's a lot of excess manufacturing capacity in China these days, and if they do not get aggregate demand to pick up and households to start to buy, yes, manufacturing would do okay, but it will be led by China. China may dump those goods on Western markets, barring tariffs and non-tariff barriers. And then you'll see manufacturers, outside of China feel the pressure. And to some extent, that's already happening with electric vehicles. It's happening to some extent in the U.S. as well. Maybe we haven't seen as much of it because the consumer has stayed strong and has continued to buy goods pretty rapidly, pretty aggressively. And that's keeping the manufacturing sectors around the world okay. But I wonder if profitability will stay strong in view of this excess manufacturing capacity in China that can be dumped into the rest of the world.
I also wonder if those American consumers will show up if there's going to be 60% blanket tariffs on Chinese goods if the former president becomes the next president.
Right, and we at Macquarie have been talking about that, right? I mean, you could have a situation where, in the case of foreign currency, in the case of the dollar can actually strengthen in the event that we have tariffs put on Chinese goods, right? Because Americans will be forced to look to their home market to purchase things, and that would be strengthening the dollar. It could also get the Fed to potentially hike or more or cut less than they otherwise would. So yes, if the point is that politics is very important with respect to whether this how the pie is divided around the world with respect to this manufacturing boom, I would agree with that. And I think the next few months in particular, because of the elections around the world, not just in the U.S., is going to be very important to determining how that pie is sliced.
You've both touched on the same topic, so let's go there. Jim, if things are so good, why are we talking about trade wars still? Why are we seeing wars take place in places like Ukraine and the Middle East as well? Why are we seeing heightened tension? To your point, if things are playing out quite nicely.
Well, I mean, look, it's a big world and people get along and don't get along, and I can't explain war. Thanks for the softball question, but I got nothing to add. But look, generally, if you look at the trends that we're looking at, you have things like decarbonization. We've recognized that the planet is heating up, and we've taken meaningful steps to build technologies that are going to address that. And this is one of the things that Immerse does. They build the things that give us green energy. They build us things that that are helping that transition. And those factors are worldwide and very positive. Now, are there going to be wars and problems? Absolutely. But the fact that we're looking at these sort of global supply chains, and everybody kind of has to get along, because you're just not going to work as any single entity. I mean, even if China decides to sort of go rogue, they can't. Nobody. The U.S. can't. Like, we're all connected, and that just makes it better.
I think ultimately this is what we're getting at. We used to think that trade relationships prevented conflict, and then we've seen what's taken place between Russia, Ukraine, and Europe. It hasn't played out that way at all. We had a massive trade relationship between the US and China, and yet we've still got tension on that front as well, Lisa.
Yeah, this is true, which is the reason why people haven't bought into this tone shift that we've heard from Xi Jinping in response to the lack of direct investment. This is one of the key questions. When does it become a real problem?
Terry Wiseman of Macquarie. Terry, good to catch up. Jim, we could speak to you all morning. This was awesome. Let's do this again soon. Thank you, sir.
So much fun.
Jim McAuliffe there, the Block co-founder. Coming up, Republican Senator Rick Scott of Florida, Keith Lerner of Truist, Kathy Bosjancic of Nationwide, and Michael Nathanson of Moffitt-Nathanson. All of that and a whole lot more. The third hour of Bloomberg Surveillance up next.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, is the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
It seems like the stage is set for the Fed to have a slow decline in rates.
If you continue to see that strong growth, you could actually get that soft landing that we had been looking for.
It does seem ultimately growth is going to have to slow.
If the economy slows more than sort of a Goldilocks landing, the Fed has room to cut rates maybe a little bit more.
I do believe in Goldilocks. Productivity is higher, and these trade-offs are going to continue to be the Fed's dream come true.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The last hour of Bloomberg Surveillance starts right now. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrell. Your equity market on the S&P 500 positive by almost 0.2%. Recovering in the pre-market, NYCB. Check out this stock in early trading, positive by almost 12%. Briefly, off the back of this story, Lisa, we have a new executive chairman to work alongside the CEO.
Again, this takes me back a year or 11 months. The fact that we're even talking about incredible volatility in a name, understand that it is trading below $5 per share, so you're talking about a lot of volatility with a lot less potential market capitalization. But how do you right-size the ship when you've lost credibility? How do you right-size the ship in the face of more zombies in the form of commercial real estate that still have yet to rear their head?
Just to share the name with you, Alessandro Dinello, who had been the non-executive chairman and previously ran Flagstar Bancorp, which NYCB had actually bought back in 2022. So that's a name for you. Executive Chairman Alessandro Dinello to work alongside the CEO to improve all aspects of the bank's operations. Just off the back of that news, the story pushing higher, the stock pushing higher. But to Lisa's point, this one has been absolutely pummeled over the last week, losing more than half of its market cap. Yesterday, we heard from Secretary Yellen on Capitol Hill in front of the House Financial Services Committee. Tomorrow, Secretary Yellen in front of the Senate Banking Committee. I imagine this is going to come up all over again.
And given the fact that now this stock, which she didn't want to talk about a specific company, but now it's a penny stock, she might have to say a little bit more. Yesterday, her quote was, I'm concerned, but she thought it was manageable. But to John and Lisa, to your point earlier in the last hour, what is she going to say? Of course she has to say she's concerned, but she also pointed to requires careful supervisory attention, which maybe compared to 11 months ago, the supervision is actually in place and looking at what's happening in commercial real estate.
We're talking about a $4 stock now, sub $4. And to Bramo's point, getting a lot of volatility throughout the whole of this morning so far. The broader market, the S&P doing okay, positive 0.2%, about 88 minutes away from the opening bell. Yields are higher by 3 basis points. Lots of supply through the next 24 hours or so, up 3 basis points to 412.69. And the euro stronger, dollar weaker. Just a little bit of strength there for the euro, 107.73. That currency pair positive by 0.2%. Coming up this hour, Keith Lerner of Truist on why stocks still have room to run after hitting all-time highs. Senator Rick Scott on the border bill that's dead on arrival, according to some, and him. And Michael Nathanson of MoffettNathanson on sports streamers going back to the bundle. Michael, later this hour. We begin with our top story this hour. Stocks moving higher as traders digest earnings and signals about the Fed's path forward. Keith Lerner, co-CIO and chief market strategist at Truist, saying this: after ending with a bang in 23, and a 9-week winning streak, the market is holding up relatively well. After a healthy digestion phase in the first 2 weeks of the year, the S&P 500 broke to an all-time high. This reiterates the importance of the Fed's ability to engineer a soft economic landing, which the market appears to be pricing in. We view this as a positive signal. Keith, I'm pleased to say, joins us now for more. Morning, Keith.
Great to be with you all. It sounded better than when I wrote that, so thanks, Jonathan.
Thank you, Keith. That's what I'm here for, just to make everything sound better. Let's talk about this equity market. You make this sound better. Are we standing on the shoulders of fewer and fewer stocks?
We are, and that is the risk. I mean, I think, as I've heard a lot of the guests, everyone wants to see this market burn out. We know it moved from the Magnificent 7 to the Magnificent 5, and maybe that changes to Magnificent 2 at some point. So we do need to see some things burn out. I will say, as you think about the overall market, we mentioned the market for 2 years didn't do anything, right? We had this big move up since October, but the last 2 years are basically flat. When you break out to an all-time high after a prolonged period, 1 year later, you're up 13 out of 14 times. Now, the caveat, the one time you didn't go up, which is what we should be focused on, is the signal from 2007, where there was a recession afterwards as well. Now, we still think recession risk is potentially out there, but we think it's not the base case at this point. I know the street is moving more towards a soft economic landing as well. But the risk, to your point, is the crowding. The equal weight index has underperformed the market cap by almost 20% over the last year. It's only happened, the extreme that we've seen is back during coming out of COVID and then back to 1999 as well. So we certainly need to see some better action from the broader market.
Last time I looked, I think we've seen 9 points of outperformance for the Mag 7 versus the equal weight S&P 500 already this year.
Yeah.
What's the recipe for better breadth, improving breadth?
Well, I think it's partly the economy. I think the economy actually surprising somewhat to the upside, but also more like Goldilocks scenario where inflation stays, somewhat constrained, and the 10-year stays below 430 or so. I think we go back above 430. I think that's going to be a risk to the overall market. We're having a lot of discussion this morning on some of the regional banks. I mean, that does show that these high interest rates are biting in some areas of the market. I will say, though, I mean, if you think about since the October low that we saw, the S&P is up about 38%. Regional banks are down 21%. So the question becomes, how much does that matter for the overall market?
You talked about resurgent inflation, and I think we have to go there, especially given the ISM services data and the fact that we have gotten better than expected data again and again. How do you see that playing out? Does that hurt Mag 7 more than it hurts some of the smaller companies that haven't seen the same kind of boom?
Yeah, it's a good question and a curious one, because in some ways, like even what we saw the last week or so, you say better economic data, better GDP, better ISM, that's good for corporate profitability, that should be good for small caps. But because of the interest rate sensitivity and the leverage that these companies still have, they're underperforming. So, I think the inflation is not going to be a straight line. I think it's going to inject the volatility. But I think this year's, one of our mottos is be prepared. This is not the time to be on autopilot. And I think there will be times that we can use this volatility as an opportunity on both the upside and the downside this year, especially with we have 40 elections as well. But I think the inflation is a risk that the economy is on a short-term basis almost feels like it's reaccelerating a little bit. The PMIs have been low for so long, they can't really be down forever. Inventories are actually very low as well. So I think that's the risk, and that's why the Fed's pushed back. I think they have scar tissue from this inflation of the last couple of years, and I think it makes sense that they push back on the rate cuts.
So we haven't heard a lot of conviction from pretty much anyone this year. It seems like everyone comes on and they're saying, we'll have to wait and see. We'll look at the data. We'll try to figure out where things are. Can you take us on a tour kind of your view and how it's shifted over the first, say, 45 days of the year as you take a look out and say, okay, we're pricing in a soft landing. It still looks like a base case. Where do you push back? Where do you change your allocation?
Yeah, so we haven't changed our allocations. I will say it was somewhat surprising. We're still overweight the U.S. globally, and we're still overweight tech, I am surprised by how quickly that the Mag 7 has reasserted itself in the first month of the year. We had that big rally that brought in the last 2 months of the year, small caps up 25%. So I think that's somewhat surprising. We didn't make a shift yet. We basically, towards the October lows, we said these markets were so stretched that we thought there would be a bounce into year end. So at this point, I mean, I think the one thing that the economy is a bit stronger, we were already saying that we thought the Fed was going to only cut 3 or 4 cuts because of that scar tissue. So not a lot has changed, and we haven't made any significant asset allocation decisions yet. We're still waiting for more confirmation on a shift to the average stock. We're just not seeing it yet, and we're going to be a little bit late, but we want to see more of a sustainable turn.
In the meantime, people are taking a look at the data and saying, what data do we trust? And we keep hearing that again and again. The latest data coming out of Citigroup's Andrew Hollenhorst pushes against some of the headline data, talking about delinquencies now on credit cards surpassing pre-pandemic levels. You're seeing this in anecdotal data. How much do you trust some of the jobs figures, the other information that suggests things are reaccelerating?
Yeah, well, I mean, I think there's some challenges with some of the seasonality issues, but across the board, if you look at job openings, quit rates, initial jobs claims, even if we say that Friday's jobless employment number was 200,000 instead of 350 or 175, that's still very healthy and actually above trend as a whole. So I still say the economy we think there's going to be a step down in growth. The labor market should cool somewhat, but it's still relatively healthy from what we see at this point. But the main thing we're looking at, too, is obviously the weekly initial claims every week. We're looking at the credit markets. Those are things that we're seeing is, are we starting to see some cracks, even with some of the issues in commercial real estate? Are we seeing it manifest itself more broadly? We're not seeing it yet. That's where we're attuned to at this point.
Keith, before you go, favorite sector right now, what is it?
Only one.
You got 2?
I got 3.
Give me 3.
I'm going to give you 3. Well, we still like tech, but I do think tech's going to consolidate here a bit.
Okay.
We like consumer discretionary, which is a mix of growth and kind of that cyclical play. And believe it or not, we do like financials, but we like the larger cap financials as well, based on the more resilient economy. So hopefully I can get 1 or 3 right, so I can come back and say I was right.
Just on number 3, which is what we'll follow up on, no doubt, in a few months' time when you come back.
Okay.
Number 3, the financials.
Yeah.
Do you think that this will be an isolated issue for a small number of small banks in this country?
If I say that and I'm wrong, you'll replay that in like 6 months.
Without a doubt, obviously.
So,
I'm trying to find out how you think about it right now.
At this point, I think the Fed, the Treasury are very attuned to this. They have a playbook on this as well. So listen, I think it's going to hurt the economy. I think we're going to see a maturity wall that picks up this year hurt. But at this point, I think the larger banks are very well capitalized, and I think the regulators are on top of it. So at this point, it doesn't seem like this is going to be systemic. But again, you got to watch to see if this starts to manifest in credit markets. We're not seeing it as of yet.
You sound like Secretary Yellen, which may or may not be a good thing in 3 months' time. Keith, it's good to see you.
Great to see you all.
Thank you, sir. Keith Lerner there of Truist. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The troubles in the U.S. commercial property market, which have hit banks in New York and Japan, is spreading to Europe. German real estate financer Deutsche Pfandbriefbank has seen its bond slump on concerns about its exposure to the sector. The bank responded with an unscheduled statement saying it has increased provisions because of the sector's persistent weakness. Shares of New York Community Bank have reversed in the pre-market trade. They're now higher. The bank named Alessandro Dinello as executive chairman effective immediately. The CEO is pledging to bring in new executives after Moody's cut the bank's rating to junk yesterday. The bank has lost nearly half of its market cap in a week after hoarding cash and slashing its dividend. The bank took on assets from Signature Bank last year, including 2 risky loans and commercial real estate. Uber has delivered a beat on bookings in earnings this morning. December's quarter marks the 3rd consecutive period of operating profit as Uber looks to trim costs. Results for the ride-sharing company were also given a boost by growing demand in Latin America and the Asia-Pacific region. Plans to return more capital to shareholders will be announced last week. The Uber CEO, Dara Khosrowshahi, joins Bloomberg TV at 11 a.m. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Coming up next on this program, a border deal that's dead on arrival.
It's been made pretty clear to us by the Speaker that it will not become law.
That conversation up next from New York. This is Bloomberg.
trillion industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
One hour and 15 minutes away from the opening bell. Equity futures on the S&P 500 positive here by 0.25%. Yields higher by 2 basis points. The 10-year 4.1230. Under surveillance this morning, a border deal that's dead on arrival.
We had a very robust discussion about whether or not this product could ever become law. And it's been made pretty clear to us by the Speaker that it will not become law.
It's the latest this morning. Senate Democrats refusing to give up on a bipartisan border deal that would unlock aid for Ukraine. Mounting GOP opposition is all but certain to sink the measure. Senator Rick Scott writing this: our lawless southern border poses a huge threat. The Schumer-McConnell-Biden deal still allows criminals and terrorists to continue to pour into our country. We need actual border security. Senator Scott, I'm pleased to say, joins us now for more. Senator, I'm just going to start the conversation by sharing 2 quotes with you, and you can help me understand who's got this right. The first quote is from House Majority Leader Steve Scalise, who says, here's what people pushing this deal aren't telling you. It accepts 5,000 illegal immigrants a day. The bill, as you know, sir, because you've read it, specifically refers to 5,000 encounters. Your colleague in the Senate, Senator Langford, said this to Fox News: if you get to 5,000, which we have been there every single day except for 7 in the last 4 months, 7 days in the last 4 months, that it completely closes the border down. It deports everyone. Senator, why are Republicans struggling to get on the same page on this bill?
Well, the problem is this is not a border security bill. It's an immigration bill. When you go back home to my state of Florida, what people want is they want a border to be secured. Chris Murphy, who is the Democrat leading the negotiations on the Democrat side, said the border will never be closed. So when you hit that 5,000, all that has to happen is all those individuals get shipped to a port of entry, and they can still come through. So it's not, unfortunately, it's not a border security bill. It's an immigration bill, and that's why it's not going to happen. It was, unfortunately, just they did it behind closed doors. They didn't ask for people's input. They sprung it on us Sunday night, and it's not something that we want to do. We don't want an immigration bill. We want a border security bill. That's why it's not going to pass today.
Senator, how are you left behind in negotiations, though? In December, in the Wall Street Journal, you, along with your colleagues like Mike Lee, were quoted as saying one of the proposals is that this would reduce illegal crossings, and that number of illegal crossings reduced by about 20,000 from the prior month's level. That's what you were looking for, those reductions of those crossings. And you said, quote, we've been told that that's part of the conversation. So you've known about some of these conversations from December. Why are you shocked now?
Oh, I'm not shocked. It was clear, Mitch McConnell made the decision that we would not hold a lawless Biden administration to secure the border. The only way we could do that is say, we will not give you Ukraine aid on a monthly basis unless the number of people crossing the border and staying here comes down. So I've always had a concern about the bill. There's a lot of other concerns about the bill, but my biggest concern never was addressed. We have a lawless administration that could secure the border today. Trump secured it with the existing law, and there's nothing in here that would make Biden secure the border today. And then Chris Murphy said, he was clear, the border will never be closed.
Does this bill, what you see, and you've read through the 300 pages, weaken any immigration law we currently have?
Well, I think a lot of concerns is that it will prevent a Republican president that does want to secure the border because it'll have some limitations on their ability to actually close the border, which the president has the ability to close the border today. So there's a lot of concern that through the court system, that people that want a completely open border, like Joe Biden does, will be able to go to the courts and forever keep the border open. As Chris Murphy said, the border will never be closed. That was their plan. So here's the problem. James Lankford is a good person, tried hard, knows the issue, but he was negotiating with somebody that didn't want to have a secure border. And he was hamstrung by Mitch McConnell, who said, we're not going to tie Biden's hands to force him to secure the border today. That's what Floridians want. They want a secure border today.
Biden says that he would close the border if this bill became law. So why not put it in his hands and see if he does it?
He could do it today. He hasn't done it today. The day he came into office, he implemented catch and release. He stopped Remain in Mexico. He stopped building the wall. He sold off the steel. So, look, Biden doesn't want to have a secure border. You're going to trust somebody that has shown you through their actions for 3 years they don't want to have a secure border? He doesn't need another bill. The only way this is going to happen is we get a president that wants to secure the border. He could do it today. He's made the decision, Biden, to not have a secure border.
Senator, I have to say, just taking a step back, there's just a lot of feeling that there's just utter dysfunction and nobody wants to negotiate with anyone because it's political season. And it makes Biden maybe have a win rather than the former President Trump who's running on this issue. How do you push back against that when it seems like some people are rejecting the bill before even reading it?
Well, I told him my concern was we got to make Biden enforce the law, and that was my concern all along. There's a lot of provisions in here that make this an immigration bill, but look, we should be doing up here is we should be having robust conversations on the Senate floor. All people, everybody there, bring your ideas, but that's not how this is done. What we've been doing, I've been up here 5 years. Schumer McConnell negotiated a deal behind the scenes. They showed it at the last minute and expect to vote. They gave us this bill Sunday night. We've not seen any text before and expected us to vote on it today. That's not the way this should happen.
Senator, I understand you don't like the way this process went done, but when you look at, say the Border Patrol Union, they endorsed former President Trump. They say this is better than nothing. You look at the numbers in December, more than 300,000 migrants along the southwest border. That's nearly 10,000 a day. I've read the text, and it says if this deal was in place in December, 5,000 encounters, the border automatically shuts. At that, if you look at those numbers, at minimum then, this would be cutting December in half. How is that not better than what you have today?
Well, it doesn't say the border closes. What it says is you have to go to a port of entry. So the border does not close. So here, why don't we go back and secure the border with the existing law? We have a lawless president. It doesn't matter what bill we pass. He's not going to enforce it. So why doesn't Joe Biden do his job? He's the president of the United States. His responsibility is to secure the border. We've got 70,000 people dying of drug overdose. We've got terrorists. We got human traffickers. We got criminals coming across the border. Why doesn't he do his job? That's what the expectation should be, is we have a president that does the job.
You have a Democratic president. You have a Democratic-held Senate. The Republicans control 1/2 of one branch of government. Why is this not an incremental step that you can build on? It is a divided government. You're going to need Senator Chris Murphy to bring his Democrats along.
Well, why don't we have a secure border? We have a lawless administration. I'm not going to say, I'm okay with 50 terrorists coming into my neighborhood. I don't want that. I think we ought to have a secure border. I don't want drugs coming to my neighborhood. I don't want terrorists. I don't want human traffickers. I don't want any of this stuff in my neighborhood. We should expect our government to do their job, secure the border. This bill will not secure the border. We don't have a president that's willing to do it. There's nothing in this bill that's going to force him to secure the border.
President Trump has been very public that he does not want to see this bill go through. Do you speak to him regularly?
I do.
And is your sense that this is the top issue he wants to run on, and that is why it's become politicized in Washington, D.C.?
He's not talked to me about it. He's not asked me not to support it. I've been clear all along. I want a secure border. We've been having the same conversation for months. I will support a bill that has a secure border. all right? But we have to remember, the only way that's going to happen is we have something in here that forces Biden to do his job. He could secure the border today. He is elected not to secure the border.
Senator, it's fantastic to catch up with you, sir. I have no doubt we'll be continuing this conversation in the weeks and months to come. Thank you for joining us today. Senator Rick Scott there on the latest situation down in Washington, D.C. That does not sound like that bill is going to see the light of day anytime soon.
No, but in the future, it could potentially work as a framework for where you see both sides of the aisle are. The issue is this is a divided government. Republicans have control of one part of Congress. And even though they had to deliver Mayorkas yesterday, Israel, they didn't deliver any of these. They were pitching this to their base. So this becomes a big problem when even the Republicans holding a majority of one part of the government can't get through some of their bills.
Regardless of what you think about the substance of this bill, and we could talk about it all day, we're not going to. Ultimately, at the moment, this is going to be and is a massive campaign issue for the election in 2024. And if you want to get into the blame game, the polling is pretty clear. It's not about what I think about it, you think about it, any of us think about it. It's not about what the senator thinks about it either. In the court of public opinion right now, they're blaming the executive branch, they're blaming the White House, they're blaming the president. Now, if you don't deal with the bill that's on the table right now, does the polling change anytime soon? Does it start to move against the Republicans and away from the White House? At the moment, it doesn't look like that at all.
Yeah, but President Biden talking about it yesterday and trying to basically put it out there, saying we gave them a bill, we gave them what they wanted, and they rejected it. The problem that I have is there doesn't seem to be an honest discussion about even what the facts are out there. And I think that when we start questioning what the facts are and people are disagreeing on that, it's hard to have any kind of intellectual debate.
Most experts are saying that this 5,000 encounters and then automatic shutdown of the border is very similar to Title 42, which Republicans loved under the Trump administration. So I think, John, starting that conversation, talking about what Steve Scalise is saying, then what Langford's saying in the Senate, was a good way. The Republicans are not actually agreeing on the facts.
They're not on the same page at all on the issue right now, and you can see that based on the communication over the last week or so. Coming up on the program, up next, Nationwide Chief Economist Kathy Bosjan says you're watching Bloomberg Surveillance with your equity market positive 0.25% from New York. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
We are 60 minutes away from the opening bell. Stocks are higher by a third of 1% on the S&P 500, up by almost a half of 1% on the Nasdaq, positive by 0.3 on the Russell. The small caps doing okay this morning. In the bond market, 2-year, 10-year, 30-year, for those of you that missed it 5 times a little bit earlier, we talked about supply. We'll do it again. Coming up later, $42 billion of 10-year notes. After that tomorrow, $25 billion of 30-year bonds. That's a lot of supply, Lisa, going into a bond market that's repriced yields higher over the last week. Up another basis point this morning, 411.53 on a 10-year, on a 2-year, 441.83.
Our regular viewers have heard me talk about auctions too much, so I'm going to channel somebody else. Michael Kudzel, portfolio manager over at PIMCO, saying the auction will certainly get absorbed, so that's perhaps a news killer. Supply can tell a story that matters at any given moment, but bigger picture, if you look at just what supply has meant for yields, it hasn't meant very much. And that basically is just the story, that basically we can paint a story and sound sensational about it. Record auction, wow, so much debt, so much interest, dozens unsustainable, and it will all get absorbed.
This is quite a mood this morning that you're running with. Quite a mood. I thought you were into supply.
I am into supply, but it's just a frustrating story because I'm into it over the longer term, and it can shatter market sentiment. But the problem is that some of the logical connections don't work when it comes to the market reality.
And that's frustrating.
It has been frustrating, yes.
I get it, okay. Yields are up now, basis point, 411.34. I mean, you sound really frustrated about this issue. In foreign exchange, the euro, 107.82, just about positive, stronger there by, let's call it a quarter of 1%, positive by 0.26% on the euro against the dollar. Under surveillance this morning, House Speaker Mike Johnson suffering 2 setbacks just moments apart. Republicans failing to impeach Homeland Security Secretary Alejandro Mayorkas yesterday by a vote of 214 to 216. Speaker Johnson vowing to bring back articles of impeachment against Secretary Mayorkas in the coming days. Just moments later, a standalone bill providing aid to Israel without funding for Ukraine also failed, raising questions here, MH, as to why this bill was even put out there to vote.
If you knew that it was going to fail, well, that's why Punchbowl this morning is calling this embarrassing. You put bills on the floor, and you know they're going to fail, and you have the majority. It's concerning.
And the bill is coming back.
And yes, and that is why Politico this morning says that the biggest factor tamping down talk about another motion to vacate for this new speaker could be the fact that they don't really have anyone else. But if he has any more days like yesterday, that might change fast. What's going on? You have the majority, and you cannot get even sometimes simple rules through.
I'm not even going to turn to Lisa to get any thoughts on procedural issues down in Washington because her head might explode. So let's talk about this instead. You hate that story.
I do hate it. Do you like it?
No, I hate it too.
Okay.
New York Community Bank rising this morning.
For me.
Some better news. The company is saying the following. Deposits have climbed since the end of last year and liquidity remains ample. The bank also announcing the appointment of a new executive chairman. Shares had fallen to the lowest level since 1997, while Moody's cut its credit grade to junk. The ratings agency citing multifaceted financial risks and saying it could slash the regional lenders rating further if conditions deteriorate. We have been absolutely hammered over the last week or so, 7 days and down 60% on that name.
And dragging down other small banks as well. I do have to say, this really is notable to me that it really has been viewed as a larger issue, and not necessarily in terms of some sort of collapse that would trigger rate cuts, which might be a positive thing for the overall market, but rather as just sort of this headwind to growth, headwind to credit creation, as Mike Wilson was talking about, and a headwind to this idea that we're going to see rates bite. It just might not happen on the scale that some people were talking about.
You've got to separate two issues, which is what you're doing, systemic risk and just a massive headwind to profitability, and tempering their ability to finance the economy could lead to tighter lending standards, less financing all round for the small and medium-sized lenders. I think that's the ultimate concern here. I don't think it has to be the doom, gloom scenario of, say, last spring, where everyone's worrying about the overall health of the financial system. With that all being said, this has been a part of the market we've been focused on now for 18 months. Commercial real estate will hurt some lenders more than others, and we know it feels like a perfect storm. We've talked about low vacancy rates, higher interest rates, the fact that people aren't coming back to the office, and the fact that these loans are all maturing, some of them, at the same time. It's like right here, right now, this year.
To take it a step further, exactly to your point, because it's not going to become a systemic failure, it's not going to trigger the same kind of policy response that previous systemic failures have. You're not going to get the bailout in the same kind of way. You will let banks fail. You will let some of the consolidation happen. You will let this company get downgraded to junk with more than $100 billion of assets. And that, I think, is the difference that people are trying to grapple with. What is the broader market implication of that there isn't that relief valve in the same way?
Watch this space, and we'll see how it develops. Let's finish on the Fed. The Fed Speak parade continues. Cleveland Fed President Loretta Mester saying policymakers will likely gain confidence to cut quote later this year, adding it would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. The Minneapolis Fed President Neil Kashkari saying, quote, we're not all the way there yet. Collins, Barkin, Bauman on deck a little bit later today. Kathy Bosch-Jansen, Chief Economist at Nationwide, joins us now for more. So, Kathy, we've had some pushback over the last week from Chairman Powell and others too, and the data has reinforced that. Payrolls on Friday really strong. ISM services this week, Monday, was just tremendous, and throw in prices paid picking up as well. Kathy, have you changed your view, your base case on that first move from this Fed?
Hey, John, good morning. Well, it does seem like it's lining up that you're going to get a later move from the Fed. We had been looking for a move, a rate cut in May, but said June was possible. And it does look like it's lining up to be either May or June. And, you know, I think they're in an interesting position here, right? Because I think what Chairman Powell told us was that a strong labor market, strong economy wouldn't preclude them from cutting rates. And I think that's still the case. But as you said, we're actually seeing some signs of a reacceleration in economic activity. So we need more data. I guess we're in the same camp as the Federal Reserve. We need to see more data before we can decide, you know, when exactly they're likely to cut rates and by how much. I think that matters as well.
So, Kathy, at the moment, you were still looking for that soft landing, or rather that mild recession developing mid-year. Kathy, can you tell us on your dashboard right now, what's guiding that call ultimately for you that leads to a mild recession in the middle of the year? Because the data we're looking at, just at the surface level, really strong labor market report, really powerful ISM services, manufacturing actually picking up and getting closer to expansion. What's guiding your call?
Yeah, no, you know, there's definitely upside potential for our call here, and the recent data do give us some pause. You know, before we got the blockbuster and surprising number on Friday for payrolls, we actually had seen a slowing in the cyclical sectors, right? So outside of government, healthcare, and education, which in the prior months had accounted for almost, you know, over 80% of the job gains. So that meant the cyclical sectors were seeing a slowdown in employment. Friday's number changed that, right? Not only did we get that strong January number, but we got the upward revision to December. Where we were scratching our heads a little bit, and why we haven't yet thrown in the towel, is that we see the work week continue to decline. And that just stands out as an aberration to everything else, but maybe it's a warning sign. Again, I think we need a little more data to be really confident ourselves that, you know, we're going to avoid this recession. The other thing is the pop in average hourly earnings standing out in a very odd way as well. And maybe there's some seasonal problems, right, with the data. We know December, January, there's a lot of seasonal adjustment factors. And the fact that the work week fell, it artificially could push up average hourly earnings. So just more clarity. The one thing I would also add is we've been watching the consumer, and what I find really striking is that the unemployment rate being low at 3.7%, yet we're seeing an increase in delinquency for payments of credit cards. To a degree, that's consistent with recessionary conditions. So if things are so good for the consumer and the labor market, why are we seeing that? And to me, and to our team, it really shows the consumers overextended themselves. And at some point, we need to see consumer spending rein in.
This is something that I know Andrew Hollenhorst also pointed to in a report this morning, that credit card delinquency data. I am wondering if it's normal, if you can point to another time when we've had this sort of no man's land, this lack of clarity, this conflicting data that people parse through and tell the story they want to tell. Is there any analog to this?
Each business cycle is unique. This one is extremely unique because of the pandemic. There is a degree of the rebound in usage of credit card that we saw, I would say, through the halfway point of last year, which just was getting back to kind of trend, right? When we couldn't travel, couldn't dine out, credit card usage plummeted. And then it's come back. Consumers started to embrace credit, and that is all good. And I think it was healthy to a degree. But then when we saw the pandemic savings be, almost fully depleted, 2.1 trillion, you see the savings rate fall, to 3% handle, and that's less than half of what we saw pre-pandemic. And then you see this increase in delinquencies. To me, that's a consumer who's run too hot and has to pare things back. Unless somehow we get an increase in supply of labor and we could continue to churn out these really strong labor numbers. That's why I think we need a little bit more clarity to see how this plays out.
As you're talking, I'm just thinking about John's question to so many different people, which is how does buy now, pay later change some of the data and sort of change the landscape in terms of understanding the consumer? Does that factor in that some of this debt isn't really even materializing in the same kind of traditional ways because the ways that people are paying for things has shifted so much?
That's a great point. We did see the consumer, and we'll get consumer credit, I think either today or in the next day or so. We'll get the latest consumer credit numbers. What we saw in December is that it picked up quite sharply, and the prior months had been trending lower. So what we know is probably that buy now, pay later was used pretty extensively during the holiday season. Now that's okay if when the bill comes due, you pay it off in full. But we suspect that that's not the case, especially for younger people. We see a reliance on that. And when you see those delinquency numbers, no one really wants to be more than 90 days late on their credit cards, right? The interest rate penalty is so high. So to me, it just shows us a consumer that is strained. And unless, let's put it this way, the consumer is not prepared for a slowdown in the labor market. That's where we're concerned.
Kathy, great to get your thoughts, an update on them after the data we've seen over the last week. Kathy Bosch-Janschid there of Nationwide. Let's get NYCB up on the screen, check out the share price. Alessandra Dinello named as the exec chair a little bit earlier on this morning. The stock positive now by 1.2%. Speaking on a call in the last few minutes, giving you a little bit of an update on what's happening with the bank on the ground, just the inner workings of it, saying it has a strong liquidity and deposit base, virtually no deposit outflows from retail branches. I'll repeat that, virtually no deposit outflow from retail branches. Going on to say, focused on doing whatever it takes to build capital. If we need to shrink, sell assets, we will. We will reduce commercial real estate concentration, Lisa, as quickly as we can.
And what you can see is the shares losing that gain that they had earlier, now up just 1.4%, including the potential for what she's now saying is loan sales as one of the options. The question I have is, if you get forced selling, when do you start getting a real-time pricing of a property that has otherwise been highly illiquid and not really market priced?
That stock is up by about 1.4%. I think, to your point, there's always been this feeling that it's art, not science, when it comes to the pricing of some of these assets.
100%. A lot of these assets have mark-to-market prices that don't reflect a market that is not currently happening. Here's a key question. She tried saying that deposits are steady and saying we haven't seen any outflows. That hasn't moved the needle. What people are looking at is for forced sales in commercial real estate, and that, I think, is what's going to get people's attention.
Credit risk, just a final headline for you, really curtailed commercial real estate origination in recent months. The communication from the bank there just a moment ago. Any more headlines there, we'll bring them to you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. U.S. investigators confirmed that the Boeing jet involved in last month's Alaska Air incident was missing bolts on its door panel. Photos and other evidence from the report suggest that 4 bolts were removed at Boeing's factory in Washington. and were never replaced. The full investigation into the incident remains ongoing and could take a year or longer to reach a conclusion. Boeing said it will review the report and continue to cooperate with U.S. investigators. Ford shares continue to gain after beating on earnings and boosting its outlook yesterday. The automaker is also the latest to lower expectations for electric vehicles. CFO John Lawler told analysts the company no longer expects to hit an 8% margin on EVs in the coming years. Instead, Lawler pointed to growing demand for hybrids, expecting sales to grow 40% this year. That's a jump from 25% in 2023. Nearly 68 million Americans are expected to place a bet on this year's Super Bowl. That's according to the Gambling Industry's National Trade Association. It's a 35% jump from last year, with the total value of bets placed to estimate surpassing $23 billion. But of that, just $1.5 billion is projected to be bet with legal outlets. Sunday's Super Bowl pits the Kansas City Chiefs against the San Francisco 49ers. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Just want to squeeze in this story from Tesla. Dana Ho and Ed Ludlow, our colleagues, writing this one up. Tesla staff bracing for potential job cuts after managers were asked to affirm whether each of their employees' positions are critical. According to our reporting, U.S. managers had to make the binary assessment of their deputies' roles. In recent days, Tesla sent out the single-line query for each job after cancelling some employees' biannual performance reviews, according to the people behind this reporting. Lisa, the stock is higher by 2.5%.
Is this from the playbook of McKinsey? How do you build staff morale? I mean, seriously, if you wonder how people would feel if you say, is your job critical? Can you justify it?
A Tesla issue or sector issue? My first question, really.
It's a great question. We just saw Ford, though, outperform with respect to their earnings. GM, the same thing. Maybe it's in terms of expectations that Tesla was something other than a car company, beating the reality of being a car manufacturer.
The latest reporting from our colleagues this morning, as again, I say, the stock is up by 2.7% in the pre-market. Up next on this program, we're going back to the bundle.
Another core building opportunity is taking ESPN, which is already the world's leading sports brand, and turning it into the preeminent digital sports platform.
Taking a step towards that conversation, up next.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
Live from New York City, counting you down to the opening bell, 42 minutes away. Equities doing okay. Session highs, actually, up 1/3% on the S&P. Yields up a single basis point, up 1 basis point to 411.34. Under surveillance this morning, we're going back to the bundle.
Another core building opportunity is taking ESPN, which is already the world's leading sports brand, and turning it into the preeminent digital sports platform. We're already moving quickly down this path, and we are exploring strategic partnerships to help advance our efforts through marketing, technology, distribution, and additional content.
And they are doing just that in the last 24 hours. Here's the latest this morning. Disney, Fox, Warner Brothers Discovery teaming up to launch a new sports streaming service here in the United States. The joint venture will include professional and college sports and is expected to roll out this fall. A name and price have yet to be announced. Michael Nathanson, senior research analyst at Moffett-Nathanson, predicted much of this, and he joins us now. Michael, it's good to catch up with you, sir. You were looking for this to take place. Any surprises for you at all overnight?
I'm surprised it actually happened because it's logical, but it puts these guys in conflict with a lot of their distributors and their own businesses. But it has to be done, right? The bundle has to shrink down to sports. It makes perfect sense.
So, Mike, can you tell me now, and this is kind of a separate story, what this is going to mean for the next sale of sports TV rights in the next few years?
Yeah, it should dampen demand because, in theory, these companies don't have to compete with each other. You would think they basically have one product, and rather than, let's say, Fox and ESPN challenging each other for college football playoff rights, they can work together. Maybe they won't be bidding blind for those rights. So those rights, we've done a lot of work in our firm. We think we've hit a top in sports rights values, and this is just going to accelerate that change, right? You saw a couple weeks ago that the wrestling rights, WWE rights, left Fox to Netflix in a global deal. And that was a good deal for Netflix. So that was a sign of the change that was going to come.
So, Michael, can you walk us through some of the financials? If you think that we've seen the peak in terms of valuation of some of these rights, what should a bundle like this cost? And how can you view the partnerships with other potential streaming services?
Okay, so that's a key question, right? We don't have a number yet of what the price should cost. I would note, though, that the companies involved have left off very important assets in their network bundle. So Fox doesn't have Fox News here. Warner's has dropped a ton of networks from Discovery and Turner. And ESPN and Disney has dropped all their non-ESPN networks. So to begin with, they really dropped a lot of expensive networks. We're waiting to see what happens on price. But in terms of the financials, I think this is going to start off as a break-even business at best, right? The idea here is to offer customers something to stop them from cutting the cord and maybe stop them from going to YouTube TV, which announced 8 million customers yesterday. So I see this as, what we've done over the years, we've done a lot of research on consumer behavior. Something below $40, $45, that's a really important price point, and that'll get people's attention. Then the issue is, Lisa, is that you have to then add Paramount Plus and Peacock to get the rest of the sports that you want, and those products could be $5 a month. So I'm looking at this as probably sub $50 a month, which is a $30 savings versus the lower end bundles in streaming right now.
Michael, who is sports supporting? Where if sports goes away, those streaming networks no longer can stand alone.
Well, sports has been preserving the economics of long-tail cable networks that really didn't have much of a calling, right? So if you look at everyone who built their business, they would lead with sports and they would add 20 channels behind that, right? Paramount has a slew of channels, but CBS drives the lead there. So I think when you start unbundling sports networks, it's going to put a real pressure on non-news, non-sports businesses, right? So, our firm's call has been consistent over the years, which is we don't want to own cable networks that are not tied to sports and news, right? So, but I give Warner's credit because they made a tough decision to not carry a lot of their networks in agreeing here. So to me, I think it's going to hurt, the Paramounts of the world, the NBCUs, and even the Warner Brothers in terms of their network portfolios over time. But it has to be done. The bundle has to get smaller.
So, Michael, I've got Hulu already. I'll be able to access this, right? Nothing changes for me.
No, you're gonna have a decision, John. Do you want to drop Hulu and take this package?
Is that what I've got to decide now?
Yes, you will. And you have to decide, do I cobble together this package by adding Peacock and Paramount to your sports bundle, right?
My goodness.
So, yeah, I know. It's the issue is that we said this a couple weeks ago. The industry is not aligned with their strategies, right? You have this fragmentation of strategies. Peacock and Paramount have done something differently than these other three companies. At some point, the world's got to come together and agree that a sports-led bundle at a certain price is the right way to go for everyone, right? Right now, you've got two outsiders who don't agree to that.
It just feels like the consumer loses every time. Michael, I'm wondering now whether the sports content providers, NBA, NFL, Premier League in the UK, they just go their own way now and have their own streaming platform instead of trying to sell it directly to consumers through NFL, Premier League in the UK. They just go their own way now and have their own streaming platform instead of trying to sell it directly to consumers through these guys.
I think there's too much risk, right? If you look at the revenues generated by these companies and affiliate fees, there's still such a large amount of, their checks are still too large if I'm a team owner to take the risk to go it alone. What we've learned, John, over the years is that streaming is a really hard business. As we talked about, it's at this point, except for Netflix, it's a no profit business. Yeah. So I'm not sure the leagues want to take that risk. If the checks are still being cut by Disney, Fox, and Warner's, we'll take those checks as long as we can.
Michael, I wanted to finish on this, just with regards to this topic. You remember Hulu was a joint venture. Disney took the whole thing over eventually. I wonder if this turns out to be like a reverse Hulu for Disney, that ultimately this becomes the vehicle to spin off ESPN.
It's a good question. I think there's probably an intermediate step where you probably need more consolidation amongst the network owners. It's a good question. I think Disney, I can't answer it because I would think if you're Disney, there's value to your question about having Disney tied to the rest of ESPN tied to the rest of Disney, right?
Right.
So that is a big cut because Disney has used sports to drive value elsewhere in the enterprise. I don't think that leads to essentially Disney being spun, but probably more M&A within the sector. So I think your question's a great one, but probably 3 or 4 years down the line, I don't think this delivers Disney to spin out ESPN on this news.
Disney reports after the market a little bit later. It feels ridiculous to talk about them after the fact that Meta added a Disney in terms of market cap on Friday. And you and I need to talk about Meta in the next couple of weeks, so let's do that. Michael Nathanson of Moffett-Nathanson there. He's had a buy on Meta, I think, since the summer of 2019. Just stuck with it. It's really picked up recently.
He's been absolutely right. He's crushed it on that one. I do wonder, though, you talk about the consumer losing. Jim McKelvey had one of the most interesting ideas, I thought, about AI going out, finding what you want to watch, charging you whatever rate that is, and that's people, that's sort of the future of how this content should be delivered.
Final thoughts this morning?
I would just say there is a feeling of frustration in the market with me.
It's not personal.
Just because it feels like we're talking about a lot of the same stories and not making progress on them. And that's frustrating because it's whether it's the economic data that's uncertain or whether it's some of the congressional issues.
I was going to say, there's the same frustrations of a lot of the same stories that are not having endings happening in Washington, D.C. Also, public service announcement. President Biden is in New York City today, so be careful on the traffic.
There we go. Get home quickly, I think is the message there. Tomorrow, Richmond Fed President Tom Barkin, Disney CFO, Hugh Johnston, George Saravelos of Deutsche Bank, and Christina Company of Invesco. Still to come tomorrow morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City for our viewers worldwide, I'm Ennis Crenny in for Jonathan Ferro. These equity markets have an irreverence to commercial real estate risk, and your event risk, that's a bond market auction. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, investors brace for the next round of Fed speak. Secretary Yellen signs the alarm on commercial real estate, and the latest U.S. border agreement is on the brink of collapse. We begin with the big issue. Fed officials fighting the doves.
It would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. If the economy evolves as I expect, I think we will gain that confidence later this year, and then we can begin moving rates down.
Has been surprisingly good news. Again, I don't want to say we're done yet. I don't want to say we're necessarily going to just glide past all the way to 2%, but fingers crossed, the data is looking positive.
A lot of Fed speak to absorb. My guest this morning, Winnie Caesar of Credit Insights BlackRock's Marilyn Watson. Good morning, ladies. Here we go. Day 2 of Fed speak drama. I'm drawn to master. The mistake is to move rates down too soon or too quickly. I look at the movement in bond markets, and I want to know what you think. 8 basis points down yesterday. Was that yield hunters arriving for the 3-year paper, Marilyn, or was it nerves about New York Bank Corp? Good morning.
Good morning. Good morning. Yeah, we've certainly seen a little bit more volatility in markets, obviously, over the past few days, given the wide variety of news that we've seen. So I think in terms of Fed speak, this is really a continuation of the numerous different communications that we've seen from various FOMC members over the past few weeks, who have been pushing back on the market, which was really originally pricing in a March cut for the first, rate cut in rates. The market's now moved beyond that, and now they're looking at maybe May or June. So, but I think essentially the Fed speak still remains pushing back on what was a pretty aggressive set of cuts priced in by the market. And I think overall, when we look at the data, the U.S. economy remains very resilient. We've seen some pretty strong data coming out in the labour market in terms of activity in a range of different indicators. And then on the other hand, of course, we have had the market looking at the issues, particularly around the regional banks. So I think there's a lot going on, and I think there's a lot for the market to digest.
There is. I mean, I'm torn between the two stools, really, between the angst over New York Bank Corp, Winnie, and this move in the Treasury auctions. Where do you come down?
So I think that this is just very indicative of where we are in the cycle. There's going to be a push and pull. Not all news is going to be good. Not all news is going to be bad. And investors have to parse out what bad news is truly idiosyncratic. And our view is that the New York Community Bank Corp issues are pretty idiosyncratic and indicative of issues within that specific bank rather than regional banks at large. And then also assess, okay, well, are valuations compensating us for that push and pull? And I think that when we talk to fixed income investors, they're looking at yields still around 4% in the long end, materially higher than that in the front end, and saying, you know, we feel pretty comfortable at this point with where valuations are to compensate for these risks.
Yeah, I mean, these yields are going to be lucrative to the market, and the bond market faces a new test today when the U.S. Treasury holds its biggest ever 10-year debt auction. That is at 1 p.m. Eastern. Mike, I'm just recentering my time clock from the Middle East to here. I keep saying tonight, but of course it's at lunchtime today. It's going to be a beast of an auction.
Yeah, 1 p.m. today we'll get the results, Manus, and it is a record offering of 10-year notes. We're up to $42 billion. The question has been how much of all of this additional paper the U.S. has to sell because of its deficits will get taken down, and at what price. So far, it doesn't look too bad. The market is still hungry for bonds. Yesterday, Janet Yellen, the Treasury Secretary, said there's a robust appetite for bonds. January global bond issuance was a record $794 billion. Treasury has now said that this is the last time they're going to increase the auction. So that takes some of the uncertainty out of what's going on for investors going forward. But as you've been talking about, we still don't know when the Fed will begin to cut rates. I want to go back to what Loretta Mester said yesterday. As you noted, she said they can gain confidence later this year before they start moving rates down. So investors still don't have a timing on that. So pricing is going to basically kind of be in the range it appears that it has been in. We noted 11 consecutive auctions of 10-year notes have tailed, and that's what it looks like today right now. The when issued chart shows very little spread between the two, maybe a slight tail on 10s, and that suggests that there's still appetite out there for it. One question I would ask to Winnie, because she was just quoted in a Tracy Alloway piece the other day, that the so-called new issue concession is about 3.6 basis points for all bonds this year, and I'm wondering if that's changed at all, if investors are still willing to take down without a lot of additional concession.
Well, let's just put that question, Mike McKee, thank you very much, straight to Winnie, which is, you know, when you look at the tails, is this going to be sufficient to draw in the buyers? It's a chunky old auction, 42 billion, a record size, but this might be the peak. Winnie.
It is absolutely a record size, and we expect that the auction today is going to go relatively smoothly for a lot of the reasons that Mike was just mentioning. Investors have more confidence around the outlook for the path of rate cuts. It may not be March, it may be a little bit later in the year than the market had initially been pricing in, but at least Fed officials are kind of universally saying, okay, so at some point this year, we'll probably be able to start cutting rates. And I think that is giving investors a lot of confidence. And within the corporate credit market, we're still seeing very solid demand for new issue. Now, it varies a little bit depending on where you are across the curve. Longer duration deals have actually done very, very well compared to shorter duration deals, and also by issuer and sector. But the amount of appetite that we've seen for the new issue calendar, all the way from investment grade down to leveraged finance, including leveraged loans, has been very strong to start the year.
Well, Marilyn, you have a proclivity to be modestly long or overweight U.S. duration. Are events like today to carry this narrative forward idiosyncratic? We clear the decks today with the 42 billion. We move to the 30s at the latter part of the week. How important is it that the 42 billion goes off without a hitch?
I mean, we also think it's going to go pretty smoothly today. We don't see there's going to be a hitch. If there is something, then of course, we need to factor that in. But I think looking at, the trajectory that we see for rates this year, looking at the underlying economic data, looking at the demand that we're seeing from investors for the yield and the carry that you can get in the fixed income market, looking at valuations, we think now in the sort of the belly of the curve and maybe the 3 to 5 year, we think, it's pretty fair value at the moment. So we do see a lot of positives now in the fixed income market, not least being that, we can get this yield that is very attractive still, and investors can lock this in. We also do, of course, acknowledge that there's going to be a lot more supply continuing this year from treasuries, and that's going to continue, we think, to obviously keep yields up somewhat. And we are positioned effectively for a steepener in the US. But yeah, we have a pretty positive view, I would say, of being invested in fixed income right now and being in US duration.
Tell me this, I mean, we debate the same tumble dryer issue every day. 3 rate cuts, 6 rate cuts, 3 bid, 6 offered, 3 bid, 6 offered. With bonds, I know, I mean, listen, I got to think about different ways to ask the same question every day, so have some sympathy. Am I stuck in this perilous 4 bid, 425 offered bond range on the 10s until there is actual action and I begin to understand why the Fed is cutting? Winnie. Sorry, I had to make a split decision there to come down off. Winnie, take it to you quickly.
Yeah, I'm happy to take that. I think that the unfortunate truth for those of us who have to opine on the markets is, for right now, it feels like we're going to have a little bit less creative things to say, because the ranges do feel narrower. And we've been talking to clients on the credit side about expect a tighter range for credit spreads this year. We've had a few years where you've seen very wide ranges in both investment grade and high yield, giving clients plenty of opportunities to buy pretty big dips and sell pretty big rallies. And it seems as if for now, as long as the Fed is on hold and investors are not anticipating that kind of big move forward in terms of cutting rates, we're probably going to be stuck in a little bit more of a range-bound market. Now, I do think that we have some potential volatility that might get thrown in as the political headlines start to heat up with the U.S. election. And as we've all learned over the past 5 years, there's always something that comes kind of out of left field that sends the market into a shock. But as we are thinking just about Fed policy and rates, it does feel like for now, expect more of a range-bound kind of tighter trading market, which is really more of a carry trade, in our opinion.
Okay, carrying clip. Marilyn, you say it pays to be flexible. With a strong focus on risk management, I'd expect nothing less. We see opportunities now in some fixed income for active managers with attractive yields. Globally, where is the most attractive to you?
So we do like a lot of relative value trades, and we're looking to really find the trades where we have the highest conviction or where we see a market dislocation. So in Europe, for example, we still like some European investment grade bonds, particularly when you hedge them back to the dollar, then you get a very nice pickup in yield. In the US, we do like areas, as we mentioned, slightly overweight US duration, but we also like areas such as healthcare services, technology, things like that. We are modestly long UK duration. And then we have a range of different trades in emerging markets, for example, in Mexico, in Brazil, and in parts of Asia as well. So at the moment, I think given the massive price repricing that we've seen over the past 18 months or so, now we really can get at the biggest price dispersion that we've seen for a long time between different issuers and different corporate bonds, different government bonds. And we do think that now you can really get at the underlying fundamentals of a name. And so, yeah, we're very diversified at the moment.
Marilyn, I'm glad you're underscoring. For an Irishman with sterling in his bank account, understanding what to do with the gilt ladder, it's important to know that that you quite like British bonds. Winnie, let me take it back to you. You are cautious, tactically cautious on credit, and I suppose is that predicated on the view that these spreads are, I mean, they'll wind up like a spring. They are quite tight, given the lack of clarity on the rest of the year. I mean, we have a no landing, soft landing scenario, but we're so juiced on these credit spreads.
Yeah, so we went out with our call for tactical caution about a week before last week's Fed meeting, as we were a little bit concerned that the very dovish sentiment that Powell conveyed in December would not be replicated at the last meeting. And that turned out to be true. We've seen some upward pressure on yields, and spreads had already reached our year-end targets for both investment grade and high yield. And we thought this is probably a good opportunity to take a little bit off the table, perhaps hedge for some seasonally technical weakness. February is historically not a great month for credit spreads. You usually see things widen out a little bit. As earnings start to roll through, we are looking to see kind of what does guidance look like for the rest of 2024, especially in some of the more consumer-aligned sectors where you're continuing to see some issues related to consumer trade downs, especially for consumer goods. You know, how much pricing can they continue to push through, which is especially important given that we've had a recent re-rise in shipping costs, given what's going on in the Red Sea and with the Panama Canal as well.
Yeah, well, we're going to keep an eye on this commercial real estate story. I think it could be the spoiler. If you just look at some of the German names there this morning, PBB, you look at some of the Japanese names, I mean, it could be that that is where the risk really lies beyond American shores in regards to the substance of any risk in commercial real estate. Winnie, Caesar, Marilyn Watson, stay with me this morning. We're going to go under the hood, have a look at some of the stocks moving before the bell. Abigail Doolittle is with me. Abby, what have we got?
Well, sticking with the theme of commercial real estate, we have wild moves for the shares of New York Community Bank Corp. Earlier, up 18% after the bank did say that deposits climbed after that dividend cut and, of course, the reserve boost, but now down 1.4%. Not so long ago, down 5%. So investors trying to decide what this means. Tesla up about 2.6% on a Bloomberg exclusive that they asked managers to make the binary decision of whether or not their employees are critical, of course, sparking layoff fears. This stock, if you can believe it, over the last year, down about 6%. So clearly looking for something to stoke profitability. And then finally, Snap, down 32% in the pre-market, heading toward its worst day since July of 2022. A very disappointing quarter was reported. Revenue missed $1.36 billion of the estimate of $1.38 billion. So it's interesting to see that big by diversification, I guess you would say, between Meta and Snap. Hard to predict, but right now Snap is absolutely plunging.
Yeah, it's where do you get your bang for your advertising buck, isn't it? And then you overlay the AI that Meta has to come, and that changes the dynamic. Abby, thank you very much. Coming up on the show, Secretary Janet Yellen sounding the alarm on commercial real estate.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
New York Community Bank losing more than half of its market cap in about a week, down 60%, as you can see, in 7 days. That conversation coming up on Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem. I don't want to comment on the situation of an individual bank, but, you know, commercial real estate is an area that we've long been aware could create financial stability risks or losses in the banking system. And this is something that requires careful supervisory attention.
The U.S. Treasury Secretary Janet Yellen there speaking in front of the House Financial Services Committee yesterday afternoon. That brings attention, of course, squarely back to New York Community Bank. Cut to junk by Moody's less than a week after it announced a surprise set of losses, cut the dividend. Moody's writing this. The move reflects, quote, multifaceted financial risk management and governance challenges facing NYCB. Meanwhile, the bank saying that deposits have climbed since the end of last year and liquidity remains ample. Katie Greifeld has the assessment on the word ample. Katie.
Well, let's start with what, of course, we heard from Secretary Yellen yesterday, of course, telling lawmakers, rather, that losses in commercial real estate, they are worried that you have this combination, this toxic brew of higher interest rates, higher vacancy rates, and also a lot of loans that are coming due. That is going to, quote, put a lot of stress on the owners of these properties. But the Secretary, she did stress that regulators are on top of it. They're working with these banks to ensure that they have adequate loan loss reserves and also the adequate liquidity levels. Their comments, of course, come as that New York Community Bank drama continues to unfold. Just to go through the timeline briefly, last week, of course, the shock, the slashing of the dividend, the stockpiling of reserves, really surprising analysts and shareholders alike. Yesterday, the stock touching its lowest level since 1997, and its credit rating cut to junk by Moody's. Today, of course, the news being that deposits have increased since the end of last year. Total deposits, $83 billion. That represents an increase from the end of 2023. And you did have the likes of Piper Sandler analysts coming out and saying that the company's liquidity and deposit positions are markedly better than almost anybody thought just yesterday. There was also some C-suite news to get to, saying that it appointed Alessandro Di Nello as executive chairman. He's going to work with the current CEO. Getting a mixed reception, I would say, in the market right now. The stock was higher. It's a bit lower right now. It really feels like investors are just trying to assess this situation, how strong this bank truly is when it comes to fundamentals before really stepping in front of that decline.
Look, this is going to come down to how quickly deposits leave the bank and whether there's a liquidity issue. We're not there yet, is our understanding. Katie Greifeld with the very latest on New York Bancorp. Winnie Caesar, Marilyn Watson are my guests this morning. Winnie, to you, fill or kill on this. Everybody's saying it's idiosyncratic. Treasury Secretary's not that worried. And one or two guests have said to me, to lose one or two banks won't be a big problem for the market. Are you as insouciant?
I mean, I would say that we take any sort of bank stress or potential bank failure as a very serious issue, but it is an unfortunate consequence, oftentimes, of rate hiking cycles, of tightening in financial conditions to see stress within banks. And I think that this was amplified by some of the dynamics within the Treasury market, longer duration securities having, pretty significant mark-to-market losses, and also just the news that focused on a lot of these banks. It can become kind of a vicious spiral of deposit outflows, but we haven't seen that with New York Community Bank, which is relatively encouraging.
Marilyn, I mean, lots of people have come on the show and they've said, regional banks have 6.5% exposure to CRE. Don't worry about it. Are you?
Not overall, no. So we actually think that, overall regional banks in the US, we think are actually in a better position than they were last year. This particular bank is in a way unique in terms of its high concentration in the New York area and in commercial real estate. There are obviously some issues more broadly around the global real estate market and commercial real estate, particularly with whether people go back to the offices or not. In many areas, not so much. So a lot of issues around commercial real estate. But I think in this particular instance, this bank has also obviously rapidly grown its balance sheet, particularly after taking over Signature Bank last year. So I think this is more of a unique case. And overall, we do think that the regional banks are in better shape, but it's something that obviously we're keeping our eye on.
Yep, and you make it very, very clear, of course, about the geography involved in this. Ladies, thank you very much for your thoughts on the markets this morning when he sees Marilyn Watson, my guest. And just a reminder of what Neil Kashkari has had to say. He sees 2 to 3 rate cuts as being appropriate in 2024 and a few more months of data. Now you got the qualification. That gives them confidence. Coming up in the show, Morning Calls, Morgan Stanley's Andrew Slimmon joins me around the opening bell on why he sees gut checks ahead in equities. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Yield hunters of the world, roll up, roll up. I'm selling some 10-year paper, not me, the Treasury are $42 billion worth of paper. It's history in the making. There was enough appetite to come in and pick up the short-dated paper there. Are you lively enough to pick up duration? We'll wait for the results on that. Time now for your morning calls on what the scribes are writing on Wall Street. JP Morgan downgrades New York Community Bank Corp to neutral, saying the departure of key executives heightens investor concerns. Next up, Citi downgrades Steve Madden to neutral, saying headwinds from higher freight costs could weigh on earnings. And finally, wrapping it up, Morgan Stanley upgrades Hermes to overweight. Why not have a Birkin?
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So
I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock, yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg.
The reason why they're all clapping is, of course, equity markets are bid up. There is no fear in the equity market from this bond market and the rise in yields. We gave 8 basis points back yesterday across the curve. You're looking at equities going for a slightly higher opening. Tesla is bid up. May there be a restructuring and job cuts there. This is the opening bell. We've got a positive day on equities. We're waiting for a record auction in the size of $42 billion. I mentioned that to you a little bit earlier on the 10-year government bond paper. Now, the euro is up by a third of 1%, squeezing a little bit higher. Could it be they get weak German data? We're waiting for the 10-year auction as well. So more pressure on the ECB to come, possibly. Bond yields pipping up by 1 pip. Don't call that a move, just call that flat. Crude up by 0.4% at 73.66. Caught in a bandwidth of $10 so far this year. One stock on the move. It's really in our focus. The New York Community Bank Corp, the lender, was cut by Moody's less than a week after slashing the payouts and stockpiling reserves, putting more concern about the commercial real estate market in our mind's eye. Abigail Doolittle has the carry through on Moody's cut.
Yeah, a lot of wild trading here. So after that downgrade, and that, of course, was after yesterday when the stock was at its lowest level since 1997, basically down 60% since reporting last week when they talked about building their reserves 12 times over what was expected, 12 times over expected to potentially cover for bad real estate loans, commercial real estate loans. The stock down 60%. Trying to catch a falling knife. Investors really not doing a good job. Then that Moody's cut yesterday, and then today the company coming out perhaps trying to reassure investors, saying that bank deposits actually climbed, that total liquidity of $37.3 billion exceeded uninsured deposits of about $22.9 billion. Total deposits of $83 billion represent an increase from the end of last year. So when this news initially came out this morning in the pre-market, as you know, Manus, the stock had been up about 18%. Not so long ago, it was down about 5%. Right now, up about 1%. Investors really don't know. They just don't know how severe that exposure is to commercial real estate in terms of office and multifamily. From a chart perspective, as I mentioned, it is truly trying to catch a falling knife, a difficult way to invest. It may take quite some time for these shares to stabilize.
Abby, thank you very much. A lot of put option buying on those stock yesterday, going for management changes. Let's flick across to Snap. The stock is falling. It's struggling. It's struggling in the ad market. There's a slump there. Disappointing on the revenue side in the holiday season. Ed Ludlow has the dissection. So, Ed, this comes down to where do you spend your ad dollars, on Instagram or Snap?
Not on Snap. I mean, they had top-line growth of 5% to $1.36 billion. The street was looking for $1.38 billion, so a small miss. The stock's down almost 32%, which puts it on track for its biggest decline since October 2022. But the context here is like Snap has done this big reshuffle within its business. Even as recently as Monday, they announced more layoffs. But if you look at the bottom line, they had an adjusted EBIT loss of $55 million to $95 million. So part of this is the street saying, well, you've been rethinking your ad platform over the last 12 months. You've taken the painful decision to do layoffs already in the last 12 months. You're doing more. That's not showing up in the bottom line either. Overall, active users grew 10%, but they grew in those core markets like North America and Western Europe. The problem is the story for Snap's been the opposite. They put a lot of time and money over the last couple of years saying, we're going after emerging markets because we think we can grow the user base there and we think we can get ad pricing power there as well. That's not worked, and now they're pivoting back. But it's a pretty big move. 30% on what's already a pretty shrunk company, Manus. I don't know if you're still on Snap these days, but you're completely right. In the fight for eyeballs, the money ain't going to Snap.
Oh, Ed, I'm feeding that many platforms at the moment. Apparently, do quite well on corporate TikTok, so I'm gonna adopt that on a personal basis now. Apparently so. Rumor has it in the newsroom. Ed, thank you very much. Ed Ludlow, who would have thought I could be big on TikTok? Talking about bonds, desperate times. Let's talk about automakers. Ford beats on expectations. You got new forecasts, higher profits to come in 2024. You got it, due to EV losses and labor costs. So there's big issues to deal with, Isabel Leonda.
There are big issues, but for now, investors are cheering the report. We're seeing the stock up around 7.5%. That's on track to reach a 6-month high. The company posted adjusted EPS of 29 cents. That's more than double analysts expected. And fourth quarter revenue also came in at $46 billion. That's also well above estimates. We have CEO Jim Farley saying, we are nowhere near our earnings potential. And to your point, there are big issues. This includes EV sales are slowing, and this seems to be a theme now. Yesterday, we had a Hertz reporting, and they also mentioned that same issue. And this forces companies to be more nimble. So Ford, for instance, is looking to balance scaling back their EV production while also dialing up output of their traditional industrial combustion engine models. And Ford is also looking to develop smaller, cheaper EV vehicles. That's to compete with Chinese models and also Tesla. And a bright spot, though, is hybrid gas EVs. Ford expects those sales to grow 40%. For 2024, Ford expects earnings of $10 billion to $12 billion. That's on the higher end of their November target. And the automaker is giving investors a supplemental dividend of 18 cents a share. That's on top of the 15 cents regular quarterly dividend. Manus.
Well, it's bid up this morning, up 6%. Isabel, thank you very much. Let's turn to the ride-sharing space now. Uber reported gross bookings that beat estimates, showing strong global demand for rides and food delivery. Katie Greifeld has the latest. Katie.
Yeah, man, it turns out people are still hailing rides and also ordering food. You take a look at gross bookings, that clocked in at $37.6 billion in the quarter ended at the end of last year. Analysts had been expecting $37.1 billion on average, so a beat there. For the current period, also a rosy outlook there, forecasting bookings between $37 billion to $38.5 billion. The midpoint of that range slightly above the average estimate of $37.3 billion. You also had Uber CEO taking a bit of a victory lap, saying, quote, it was a standout quarter to cap off a standout year, but shareholders not as impressed right now. You can see this stock is currently down almost 2%, and that's simply because the bar was so high. Uber shares have just about doubled over the past year. They hit a record high in the run-up to these results, and they have also crushed their biggest rival, Lyft. But looking forward, the company did say that it's going to proceed with an earlier pledge to return capital to shareholders. It's going to provide more details on those plans at an investor event next week. So stay tuned, man.
With the white chevron, the blue sleeves,
now that I've arrived in New York,
the white star on the red cap.
The Uber grows margin and grows revenue. Katie, thank you very much. Well, Morgan Stanley's Andrew Slimman
Next post was number 5.
Into what to expect for this year.
Where's the red and
Breadth is narrowing. To me, the market is looking tired. That alone is a reason to be more cautious. However, I don't expect more of a correction until later in the year. Good to see you this morning, Andrew. Cautious. What does cautious equate to in terms of action? What level or gravity of caution do you have? Good morning.
Good morning. Yeah, look, I mean, the market has rallied 20% off the October low. It's been up 13 out of 14 weeks. And I think the market and the breadth is narrowing. It's a sign of the market tiring. So maybe when we hit 5,000, which is right around the corner, that the market takes a breather. Could we get, a 5 to 10% correction off that level? I think it's possible, but I expect
Master Levers, horse
more
number
of a
2, you say
pullback
nothing, wearing the
later
black
in
jacket.
in the year because
Beige
I don't
stars on the sleeve
see
and a red cap.
kind of the fundamental
Jack Tudor.
framework to cause a
Just
bigger
the 5
pullback
runners now
right
then for
now.
race number 3,
Than just,
the Linda
we've
Jones
had a very
Memorial
good
Handicap Steeplechase
run,
is
and
timed to start
investors
at
might be looking
2:40.
to,
As you heard
cash
from
in a
Rollitt,
little
the racing over 2
Now,
miles
look,
in the
it's an old saying
Starts
of,
opposite the
a man that
grandstand.
tires of London
They're
is
up
tired of
head
life,
round
but
to
a
the
man
lamp
that
post and then
tires of
complete
big
another
tech
circuit of the track.
will surely be
And they'll
challenged. Now,
jump
you're not
13
exactly
fences in
tiring
total.
on big tech, but you
The betting's very tight. It's
you
5
are
to
still,
2. Horse 1, Galisa
very
McCullough, and
strongly
11 to 4
biased
leading
towards the
force.
Microsoft, the Apple, the Alpha. I was looking at your
They're
fund.
betting 4 to 1, Duo,
Are
Don
there-
Fur, and 9 to 2. You say
if you were to
nothing.
take a traffic light
5 to
system
1,
to
Harold
that,
de Marais.
where are you? Still full green?
5 runners then.
Quasi
For race
amber,
number 3.
certainly not
Our
red.
off time is 2:40.
Yeah, I mean, I think it's important to take a step back. I mean, what drives stocks is earnings and earnings revisions. That's the important thing. Where are the positive revisions coming? And boy, oh boy, they're coming in a lot of different industries right now. And one of them is in tech. Now, as we all, lots been, discussed, it's no longer the Magnificent Seven. There is bifurcation going on, but largely these companies continue to report excellent quarters, generating a lot of cash flow. So I don't think it makes sense to, sell them and look elsewhere. I think it's been a mistake until companies really express more cautious, and we're just not seeing it. So my correction is maybe trade, take a little bit off these positions, but I think they'll be higher by year end.
You know,
All 5 runners are
when
safely
you
down
look
at the
at
2 mile 1
so
furlong
much of
starts.
this risk, proclivity for risk, we started with one of the worst years for risk across assets since like the late 1990s. Here we are, we're a month into 2024. When you stand back and you look at risk, do you just incrementally deploy because to fight this momentum in the market is perhaps folly?
Yeah, no, well, it depends. I mean,
The flag
it
has been
depends really
raised,
what
lines
your
are being
the
called
time
forward
frame
towards the
you're
starting
talking.
tape.
Look,
Okay.
the time to act, I was
Set
very
to go,
convinced and
and they're
articulated
off.
on these shows
They're
that,
racing for the
that,
Linda
that the
Jones
market was going to
Memorial
rally
Handicap Steeplechase,
because
heading
it
to the
takes
first
a
of
year
13
of
fences.
investors selling
One of the first to
off
begin
the
the black
low
jacket of You Say Nothing,
until
a slight bob on landing from
they flip and
Duo
they
Don
start
Fur
buying.
at fence number
And
1,
that's
hooked
always
up
been the case.
by the
And
jockey.
last year, the
And
Bears,
Smith Chaston keeps the
kept
partnership
fighting it.
intact.
People
They
kept
race on quickly to an
selling.
open ditch.
The
Fence
market
number 2,
rallied.
You Say
Companies were
Nothing
buying
over in
back
front by a
stock, and they
half length
flipped
to the
in
grey
the
horse,
fourth quarter.
Harold de
So
Marais,
it was a
who took that
time
in
to add a
second.
lot of
Duo Don
risk.
Fur back in
Was
third
really
in front of
going
Galisa
into
McCullough,
October of
and
last
leading
year
force at the
on a
back, quickly on
short-term
fence
basis.
number
I
3.
think now it is
All over
a
that
time
okay,
to
although
be
the back marker leading force just
short-term
ballooned it a little
cautious
bit.
on risk.
So they race up
I would
towards the
look
top
at
of the hill. A
high
decent
beta
pace being
stocks
set
have
here
done
by
very
Jack
well,
Tudor
maybe
on
take some
You
money
Say
out of
Nothing,
them.
the black jacket
But
with the yellow
to your
stars on the sleeves and a red cap.
look,
In front by
investors
just over a length to the grey
only
horse,
start
Harold de
buying
Marais,
market
and Jamie Hamilton racing second.
And
Centre
that's,
pack, Duo Don
that's
Fur,
going
the
to
red and
continue
white
this year.
check with the dark blue
Sentiment
sleeves
is
for Emma
going
Smith Chaston.
to,
And then the
cash
purple
is
jacket
going to
with the yellow
follow
check
sentiment.
sleeves of leading
And I think it's
force
going to be a
and
good
Mania,
year for
and a half
for
length back
market,
to Galisa
but you
McCullough,
have
the
to
orange
be
and
more
black for Peter Summers. A narrow back marker, but only 4 lengths off the pace as they go to fence number 4.
There was very little
Taking this on the
volatility in
descent
market.
then,
The
over
VIX
in front,
stayed,
You Say Nothing, sees a
very
strike,
low.
jumps well, gets
Markets
away
went
by a
out
couple of
up
lengths
8 out of 12 months.
to Harold de Marais.
Yeah, there were a lot of people screaming it wasn't going to happen.
Duo
But
Don
market pretty
Fur,
much went
second
straight
and
up.
third.
And so I think,
Second last at this stage,
reversion
leading force
to
of the back
mean
marker,
means
Galisa
more
McCullough. Down the
volatility
hill they
this
come
year.
then towards the thickest
The
fence.
Bears
This will be the
have
final
a better
fence
day at
in a
times,
circuit's time. It's fence number
but
5
it will be
on this
higher
circuit.
by year end.
And it's You Say Nothing.
I'm just looking at the
who presses
headline
on
that
in
we've
front.
just popped on
At the fifth,
NYCB.
once
This
again,
isn't to
jumps
dig
well.
into the story on
It all sailed over
NYCB. This is
fence
to
number
dig
5
into
fines, up towards his
the
eight, just over a
conversations. To what
circuit
extent are
travel.
people talking about
And,
this
probably
in
5
your
lengths
shop and on the
separating the runners
street?
as You Say
And
Nothing
what
leads
is the
fastest with
market
a circuit
saying,
left
Andrew,
by a
about
length.
NYCB
To
and
Harold de
the
Marais racing second.
idiosyncratic nature of it, the New York nature of it? Can it be a spoiler? Can it be a grey swan that morphs into something? The German stocks are under pressure, Japanese stocks are under pressure, the New York stock is under pressure. Is
yet to be headed then.
Idiosyncratic
at the
or
Once
something
again,
a little
jumps
bit
well,
more.
as does Geraldo Marais.
Yeah, I mean, very good question.
So heading towards the back
But
stretch,
if
they're
you
about to
ask me
swing a
what the
left-handed
market
turn
is
to make
saying,
their
the
way
market's saying
into
it's
the back stretch,
idiosyncratic.
away
The
with
market's
5
sitting at
fences
all,
down
you know,
there, the
it's-
fourth of which,
it's
fence number
close to
Do you
5,000
like that?
an open
market.
ditch. Next
You
up
lived through a few cycles with me. Do you like that?
Absolutely.
And you
I
say
think
nothing
there
continues to
are,
lead by about a half length to
reasons to
Geraldo
actually
Murray, who
be
took that in second.
optimistic
Slow
on
jump by Khalees
financials. I'm just not sure
at the
the
back of the
regional.
field at
I
that one,
know
as they press on quickly to
that
another
there's
plain
going to be
one.
more
And
volatility.
they've all negotiated that one fine.
That I'm confident.
So,
Could this cause
going down towards fence
more
number 9, they've completed the
volatility?
circuit,
Yes.
and it
Is
continues
this
to be
going
you say
cause
nothing over
a
in front by a
systemic
half length
problem
to Geraldo
throughout
Murray, who took
financials?
that
I
in
do
second.
not
A gap of
believe
3
so,
lengths to
but,
Duo
you know,
Donfer, and then 3 more
again,
to leading force, who's
I
getting
know there's going to be
reminders,
more
and Khalees
volatility. You
McCullough a
tell
bit
me what's
outpaced at
going
the
to
back
cause
as they
it.
go to the
Could
ditch,
this be
fence
it?
10, and Geraldo
You
Murray
probably
jumped
quite
up
like the
and
volatility.
jumped
I'm
past,
curious, you know, I know
say
that you can
nothing.
talk about
So
Microsoft
going
specifically. I
towards
mean,
the top of
Satya
the hill,
Nadella puts
fence
his
number
anchor
11
down
is
on
3
India.
fences out.
It's gone to a
We've got a
$3
new
trillion
leader,
market
Geraldo Murray, over
valuation
in
under
front.
him.
Gets away by
And
2
again, he
and a
talks
half.
about the
Now
AI
challenging for second, Khalees
opportunities.
McCullough, who's just unseated
Does
and
its
gone wrong, I think,
magnificence
down
just
the
shine
back
within
of
the
the
Mach
field?
7?
So towards the top of the hill,
Well, I mean,
on
maybe
the
I'm just
inside,
not
the grey
that,
horse, Geraldo Murray, now tackled by Duo
tech savvy, but I
Donfer,
can
who's sweeping through to lead
understand
by
the
a neck as they go
Microsoft
to the top of the hill. You
story,
say
which
nothing,
is
has found
you
pretty
have
little back
Windows,
in the
you
field.
want
He's a bit back to be
Copilot,
past
it's
the
gonna
third
cost
by
you
leading
more.
force,
And
but the leaders are swinging the turn to come
estimates
back
for
towards the
this
second
year
last
and
fence,
next year in
and it's
terms
Duo
of
Donfer who's gone on
the
for Emma Smith
absorption of
Chaston by a
Copilot
length, maybe a length
is
and a half in
relatively
second,
muted. And I think
giving
it's going
chase
to
is Geraldo
be,
Murray,
rolled out
and they're
much
clear
more.
of leading
They're very-
force, and then
they're
you
very
say
quiet
nothing
right
at
now
the
in terms
second
of
last.
actual
Duo Donfer
numbers.
just put down
As
a
the
little
year
bit, but a mistake
progresses,
by
I think we're
Geraldo
gonna
Murray in
learn.
second.
It's-
Down the hill they come,
more,
1 fence to go, then
you know,
Duo
it's-
Donfer
more
just given
people
a
are
couple
using
of
Copilot
liveness,
than
leads
are
up by
currently
6
in
or
the
7
estimate.
lengths.
So
Geraldo Murray
that's
plugging away in
a reason
second,
to
staying on
stay
behind his
long
leading
that, but
force, and they're
I
well
think
clear
there
of you
are
say
plenty of
nothing as they
value
come down
areas,
towards the 13th and final
industrials,
fence, working
in
hard. Emma Smith
financials,
Chaston
in the
on the leader,
market,
Duo
opportunities. So I
Donfer,
like
but she's
a
got an
balance
8-length break on the
between
field. Taking
growth
second
and
is
value
leading
side
force at the
this year.
last.
I leave you
Duo
with this
Donfer
thought
over
from
in
the
front,
demo.
leading force in
Okay.
second. Geraldo Murray's gone at the final
have
fence.
never seen a rate of
Inside the final
diffusion of
half
any
furlong they
technology
go.
like this
Duo
in the
Donfer punched out,
70-year-long
will go on to
computer
land the
age.
spoils from Mickey Hammond
We all
and
need
Emma
to go
Smith
back and
Chaston.
read
Duo Donfer goes on
Greenspan's
to win.
speech on
The leading
paradigm
force in
shifts
second.
in technology.
You say nothing in
Putting it out
third.
there. Andrew, thank you very much. Andrew Sliman there of Morgan Stanley on the calls in the market. Coming up, President Biden plays the blame game.
Now, all indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump.
The bipartisan bill on the border security and aid for Ukraine set to fail. The conversation with Amy Hordan.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
The result of all this hard work is a bipartisan agreement that represents the most fair, humane reforms in our immigration system in a long time, and the toughest set of reforms to secure the border ever. Now, all indications are this bill won't even move forward to the Senate floor. Why? A simple reason: Donald Trump. Because Donald Trump thinks it's bad for him politically.
The latest U.S. border deal on the brink of collapse. President Biden there placing the blame squarely on the Republican presidential frontrunner Donald Trump. Biden says that Trump pressured members of the GOP to reject the bipartisan immigration bill that included aid for Ukraine. Amory Hordown has been tracking this. It's a bit of a high-risk strategy, isn't it, for this blame game straight off the pulpit? But where are we in this? I mean, this bill is all but dead.
All but dead. There'll be a vote today, and it's likely to fail. And then what Senator Schumer is likely going to do, according to our reporting and some other reports out there, is going to put basically test the waters with another motion on the floor to see if he can get the aid through for Ukraine,
So
Israel,
that would be a
and
clean
Taiwan. It wouldn't include the border. But the issue is, if this is able to pass in the Senate, which the Democrats have control, and there are a lot of also defense hawks in the Senate that want to see aid to Ukraine, want to see aid to Israel, want to see aid to American partners in the Indo-Pacific, if it's able to pass in the Senate, there's still a question of whether or not this could pass through the House of Representatives, and Speaker Johnson could put this on the floor. The Republicans have really come out in the past few months and said no more aid to, say, Ukraine without fixing the U.S. southern border. And now it looks like these two issues have to be delinked because Republicans in the Senate do not like this current border deal that you just heard the president talk about. And he's saying that if that doesn't pass, which it's not going to, he will make it an election issue. It's funny because they both want to make immigration election issue.
But can this country run for another 6-7 months with I'm not saying an open border, I'm just saying a less
overwhelmed border.
An overwhelmed border. Thank you for helping me. But in the end of the day, 6 out of the 10 swing states put the blame at Biden's door for this migrant crisis. He needs a fix.
Well, this is why the former president, Donald Trump, said this would be a gift to Democrats. He's looking at the same polling we are. The latest NBC News poll over the weekend showed there's a 30-point margin to Trump's favor when it comes to who would be better when it comes to immigration and the southern border. I was really taken with the fact that the border union, the southern border, who endorsed former President Donald Trump, says this is a good deal and they should put it on the floor and they should vote for it. This is where it becomes a little bit of policy versus politics.
Of course. Well, that's the same in every capital in the world. Talk to me about Haley in Nevada. I mean, she scored less than tick the box for none of the above candidates.
Right, Nevada's
What does that mean? You're going to say is idiosyncratic and I shouldn't get too heated up about it?
No, I mean, Nikki Haley has a really, really steep path forward. It's all but done to be Trump's for the nominee, especially when you look at her home state where she's 20, 30 points behind the former president. Nevada was a little bit interesting because she ran on the primary and Trump's name was not on the primary. He's going to do the caucus, and it's pretty much all for him. But the optics of it are embarrassing.
Does she drop out before? Does she drop out? What are people saying to you in Washington?
Nikki Haley wants to go to her home state, and she will continue to fundraise until she gets to her home state of South Carolina, and that's the one to look for.
Okay. I'm Anne-Marie Hordan, thank you very much, keeping it real on the political front. Let's get some sector price action for you. It is an equity market show after all. Abigail Doolittle is with me. Politics and equities. What better can you ask for?
Absolutely. And the stock side of it, we're looking at gains for the S&P 500 up about 0.4%, up for a second day in a row. Most sectors are higher, so it is a broad-based gain. Communication services up about 0.7%, the best sector. Meta, the best stock in that sector. To the downside, though, real estate down 0.4%. And of course, you know, we have New York Community Bank Corp reopening. It had been halted, Manus, after all the volatility we were talking about before. It initially opened up down 10%. Now it's down 6%. So investors really uncertain. Now, it's interesting because if we take a look at the real estate index on the year, it is down 5% too. That's not a direct reflection of anything happening with NYCB. These are REITs and other, there's a lot of very solid companies in there, but just the fallout fear, the contagion fear taking this sector down, even though yields are much lower than they had been last year. So stay tuned on this one for sure, Manus.
Abby, thank you very much. Abigail Doolittle. Coming up on the show, market moving events to set your clock by. It is your trading diary on Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you know, you might be able to write poetry.
There are no nerves in this equity market. You've got the Russell down by 0.6%. We're waiting for the biggest 10-year bond auction ever. So there are no nerves in the equity market for the big bond auction to come. We'll bring you those results with the tail, if there is one, a little bit later on. Set your agenda. This is Fed Speak Week, and it kicks off 11 a.m. today. We'll hear from Collins, Barkin, and Bowman. As I said, 42 billion of 10-year paper comes down the pike at 1 p.m. And Disney, a whole new world. The results will come after the closing bell. Thursday, Janet Yellen will speak again, testifying in the Senate. And Friday, it is about the CPI revisions. Right now, these equity markets are resilient. That was Countdown to the Open, and this is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. You're listening and watching Bloomberg Intelligence. Alex Steele, Paul Sweeney here with you. We focus on the research, the investment research coming out of Bloomberg Intelligence, which is Bloomberg's investment research arm. We got 400 professionals around the world covering 1,200 companies, 200 industries, equities, fixed income, you name it, we cover it. We like to feature some of those analysts, and we'll do that over the next couple of hours. We're also going to check in with Carol Schleif, CIO at BMO Family Office, to get her thoughts on these markets. Steve Mann, Bloomberg Intelligence, he's got to tell us what's going on at Tesla. Are they going to have layoffs there? And Herman Chan, also Bloomberg Intelligence, he covers the regional banks. New York Community Bank, not a good situation there. We got some downgrades there. So what does it mean for the regional bank business? We'll cover all of that coming up. But first, we're going to go to John Tucker for a Bloomberg Business Flash. John.
All right, thanks, Paul and Alex. And we will take a little deeper dive into a couple of those stocks you just mentioned. The major stock averages right now all higher. The S&P 500 headed for another record. 7 of the 11 major industry groups in the index, they are green right now, being led higher by communications services. You're also seeing shares of Tesla. They are higher. The company may be considering cost cuts, as I just mentioned. Biggest drags, that is coming right now from real estate and utilities. Meantime, Keith Lerner at Truist Advisory is still concerned about the stock market breadth.
Everyone wants to see this market boring out. We know it moved from the Magnificent 7 to the Magnificent 5, and maybe that changes to Magnificent 2 at some point. So we do need to see some things boring out.
And then in company news, New York Community Bancorp's credit grade rating has been cut to junk at Moody's. Moody's saying the bank facing multifaceted financial risks and governance challenges. As a result of that, New York Community Bank shares, they are down again today. down 7.5%. Overall, the S&P 500, 20 points higher. That is up 0.4%, 49.73 on the index. Again, if we close there, that'll be another record high. The Dow Jones Industrial Average, 96 points higher. That's up 0.25% right now. The NASDAQ 100, 84 points higher. That is up 0.5%. 2-year yield, 3 basis points lower. That's at 3.72 right now. The 10-year, 1 basis point lower. That's 4.08% there. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. Is this in my face?
It's just not enough.
I had it coming to me.
Yes,
Not enough.
I hope it's your face.
Exactly.
Whose face would it be?
No, I mean the microphone. I don't want it blocking.
No, we need to make sure that we see all the beauty.
Okay, so we're on YouTube.
Yeah.
We're streaming on YouTube.
Hey
That's
guys,
the video
you can
thing.
get makeup just like me. That's all I'm saying,
There's
right?
nothing they can do back there for us, John.
You'd be surprised.
They just say,
They do good
They
stuff.
do have extra paper bags, I'm told.
Exactly. All right, John Tucker, thank you so much. We appreciate it. You're listening and watching Bloomberg Intelligence. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're also streaming on YouTube, so you can head over to youtube.com and search Bloomberg Radio. We're also in your dashboard. Get the Bloomberg Business app. We're right there. You can click on and get all the stuff you need here for Bloomberg Radio, TV, Bloomberg News. It's all right there on the app in your car. Looking at the markets here, a little bit of a lift to the market. We'll take it. A little bit of green on the screen, as John was just telling us. Let's see what's happening with some of the specific names in the equity markets. For that, we turn to Nora Melinda. She covers markets for Bloomberg News. Nora, what do you have for us?
Taking a look at Snapchat this morning, those shares are plunging as much as 32%. That's the most since 2022. Essentially, the company reported that its holiday sales have disappointed. It's just a week after its much larger rival, Meta Platforms, posted the best sales growth in 2 years. I don't know about you all, but I didn't realize that it actually had that as a direct rival. I didn't really think that it really compares, but
here's the way I think it works, and I don't see how Snap and Pinterest and anybody other than Google, Facebook, and Amazon survive in the digital ad space, because those big three players, if I'm a digital advertiser, I'm just buying those three.
Right.
Why do I have to get super smart and try to figure out, do I want to allocate money to Pinterest or Snap? Yeah, do they have a little bit different demo? Yeah, maybe. I don't know.
You have to do it if they have user engagement and daily active users that are growing, and they didn't. So it was the user engagement concerns that were weaker. So you can make an argument that if they did have that, that would be something, and they didn't.
Yep.
So then you're absolutely right. Why would they go there?
I think as an advertiser, I'd just be lazy and say, just buy the big
and just
three.
do them all.
Yeah.
But I mean, I think the other issue here is that, back in 2021, that's when Apple came out with some of these extra privacy protections and settings for users. And as we know, Snap actually depends a lot on advertisements. And so the CEO has really been trying to get this company back on its feet. Doesn't seem to be doing so well in terms of the holiday season.
So you're also looking at KKR Mortgage REIT. It's a real estate finance trust. What I find interesting about this, on the heels of New York Community Bank, which we'll also talk about later on in the hour, what's going on with this stock? It's down 14%.
Yes, it's plunging pretty significantly today. It's dragging on the real estate sector. As you all know, I cover real estate, I cover REITs, and this firm is interesting. It invests in commercial real estate. And as we all know, REITs are known for their dividend payments. And right here, we're seeing this company slash its dividend to 25 cents from 43 cents per share. That's a 42% drop. So investors are not really happy to hear this news, and this is coming after a nearly $59 million loss on a Philadelphia office building. It also added 2 multifamily assets to its watch list. It's got one in North Carolina and then one in San Diego. And this is really just showing that these commercial real estate woes have extended beyond the office space.
Boy, I'm looking at this, and I see it's only got a market cap of like $700 million, but I'm looking at it. Why isn't this stock down 50 or 70% before today? Because its business is making loans to commercial real estate, and all we know is that that may be the worst place to be.
Right. I mean, everyone's afraid of this sector right now.
Yes.
Nobody wants to touch commercial real estate. So to your point, it's crazy
interesting.
that this is the case.
Okay.
All right, and one of the best performing stocks in the S&P is Enphase Energy. Full disclosure, one of my friend's husbands, will pump this stock to whomever will listen. He loves this stock.
What do they do?
It paid for his new pool in the
wow.
back of their house.
Nice.
He's a camera guy. He just likes to trade stocks for fun. So,
okay.
full disclosure on this. What's going on here?
Enphase, those shares are climbing as much as 23%. This is just shy of its biggest gain in 2 years. It predicted a potential bottom for the industry in the current quarter. Its CEO did say that Europe is already showing signs of early recovery, and he expects non-California states to bounce back quickly. So now just kind of running back on what things have been as of recent, we've had regulators in California, which is the biggest home solar market, slashing incentives for homeowners to own systems. And this has really dragged on the solar manufacturing market. It's really been suffering, especially as we think about interest rates and how it's been more expensive for customers to buy equipment. So this news from the CEO from Enphase today has really sparked a rally across the sector.
All right. I mean, it's a solar energy company. It's got a market cap of just under $16 billion. Stocks down 12% year to date, but as you mentioned, up 15% today, down 50% on a trailing 12-month basis. So people... Where are we with solar?
I mean, I think the thing is, if you're going to put a solar panel on your roof, like Enphase is going to be part of that.
Okay.
In some capacity. So for solar, it's just an adoption kind of thing. Right. I mean, the prices are coming down, so that's good. We'll be able to make all the components here rather than in China and put the stuff together. That's kind of a different story. In terms of commercial solar, you know what's really lacking? The thing that hooks up wind and solar to the grid. There's a little like hook. It's like a piece that you stick into the grid, and that is in really short supply.
Really?
So you can build like all the things you want, but you can't connect it to the grid.
Interesting. All right, this company, Enphase, ENPH, is the ticker. It's based in Fremont, California. My experience with solar is the Princeton campus for Bloomberg has got a huge solar farm. I mean, it is awesome, and they took us out there when we first were there and to take a look at it. It's awesome. It's been there for a long time. I think they were like on the cutting edge. Plus, the Bloomberg offices down in Princeton have EV charging things, and they had them when they had them there before there were EVs, before there were cars. So they sat empty for a year or two. Now there's this huge, and everybody just kind of, when their cars charge, they take off the charger and somebody else moves their car in. So that's how the good folks at Bloomberg down in Princeton doing the EV thing.
The more you know.
That's how it works. All right, good stuff.
I got to go there.
It is. It's awesome. You gotta go
Take me
there.
with you.
Renovated. Great food down there. I mean, you think our food's good here? Food in Princeton is world class.
We've got competition.
I didn't say that.
Yes. Oh, you don't? Oh,
we have good food here.
We have good food. We're plenty. The quiche yesterday
bag
was
of
awesome.
peanuts and a Danish.
The quiche yesterday was
Danish?
Banana pudding yesterday.
I guess I should.
We have
he
it
was
very,
long gone at that point.
I guess if I'm going to complain, I shouldn't do it on the radio.
You're lucky you're not.
It's probably a really good point.
Exactly.
Yeah.
All right, Norma, Linda, thanks so much for joining us there. Appreciate that. All right, let's get a sense of what we're doing here with this markets. We're about halfway through the earnings for the quarter. We've got a Fed that presumably is in the mood of rate cutting. So what do we do here? Carol Schleif joins us. She's a chief investment officer at BMO Family Offices. I remember when they were Bank of Montreal, but consultant came in and said BMO and shortened it to BMO.
Yep.
So, but Bank of Montreal bought a lot of my loans that I originated at Chase, so we love those folks. Carol, what are we doing with this market here? I had a great November and December. I'm not sure if everybody else did, but I had a great period there. I'm wondering, what do I do now in 2024?
Yeah, November and December were definitely fun periods, especially coming up after October. But we think the markets got a little over their skis with exuberance about how soon and how often the Fed was going to cut this year. And so some rationalization of that coming into this year's actually makes a lot of sense. But our approach really hasn't changed much. We actually were in the soft landing camp all of last year from the beginning of the year on, thinking the Fed was going to be able to navigate both keeping the employment and the economy humming along while we were seeing inflation straighten itself out. But coming into this year, keeping that balanced approach to risk where you're getting paid to invest in some bonds, so having that portion of your portfolio maybe out of cash into some of those higher yielding short and intermediate term bonds, but then also not wanting to back away from a growth oriented sort of, we think the economy's in decent shape. We think you'll see a broadening like you saw in November and December last year. The most encouraging thing about that period was seeing that broadening of the market, the participation. You narrowed it up on the good days here as we've had earnings from the Magnificent 7 or 5 or 2, as you were talking earlier, but really be necessary. And we think
so, Carol, but I guess I wonder when we get there, because it doesn't seem like no one's going to sell right now. That feels clear, right? The hurdle to sell feels really high. But if I have money in a money market fund, the hurdle to then buy here feels also really high. So what am I supposed to do?
Yeah, it does. It feels high until we're looking back and the Fed's done a couple cuts and all of a sudden your 5% in cash is 3.5%.
So I need to buy small caps now?
Smaller mid cap in terms of more broadly, and there's ways to do it in a passive way. There's ways to look through, are there interesting sectors or industries or actively managed ETFs that you want to be part of? There's some secular stories going on out there as it relates to artificial intelligence, as it relates to infrastructure rebuild. There's some active ETFs that follow those segments, if you will. And so there's interesting ways to play it. And then again, too, even if you have passive S&P exposure and dollar cost average into that, you're getting participation de facto by the overweight in those major indexes to technology in the United States here in particular.
So, Carol, when you talk to your clients at BMO Family Office, the financial consultants at BMO, what's the ETF allocation for you guys? How often do you recommend an ETF to get at, maybe just exposure to fixed income or just different asset classes? So, how important are ETFs?
Well, ETFs play a role, so do active and passive. We also have passively managed passively managed tax efficient strategies where we can do separate accounts. So there's a variety. It depends on the size of the account. It depends on the inclinations. If we're going to take and say adopt an exposure to an extra exposure to Japan or artificial intelligence, we might take a 3 to 5% position in a particular ETF or a suite of ETFs. If the account is such a size that we want to use ETFs to deploy some short, intermediate, long-term bonds, the whole position might be in a variety of ETFs, and they would most likely be passive there.
What do you really hate right now? Like, what can you not touch?
What could we not touch?
Yeah.
I'm not sure, depending on the client, that there's anything we really hate, if you will. That's part of being balanced. We're going to be underweight some certain things. Emerging markets, developed markets in Europe, we're underweight those relative to the overweight we've had in the United States. Sector-wise, it's tough because there's a lot of interesting things going on, especially from a secular build standpoint in the United States. And there's a lot of things that are overlooked and unloved. We don't hate technology, but clearly that's where all the emphasis has been. But there's a lot of things like industrial and infrastructure companies where when you look at those as sectors, they're only 10 or 12% of the S&P. And we think you'll see that grow as we reindustrialize and bring manufacturing back here as we build out the grid. You mentioned having the green and the hook you need to get it on the grid. Also in places where, take Minnesota, where you've got the western part of the state is where the solar can be built, but it's not attached to the grid. So they actually have to build hundreds of miles of transmission power just to get it to the grid.
To be fair, there is like a name for that thing.
That thingy?
But I just know it as the thing that you need to plug into the grid.
Right.
But there is an
That's
official
all we
name.
need to know.
The pluggy thing.
It's the pluggy thing. We'll just coin that right here.
So, Carol, we're about halfway through earnings here. Is anything kind of jumping out at you here? Are you okay with the earnings? Do you think we're seeing some cracks maybe in the earnings power out there?
I think the thing that jumps out at me on earnings is that you can't broad brush stroke even an entire sector. There's been a lot of dispersion in those sectors about the haves and the have-nots. There's also been a lot of dispersion in how investors are treating them, because a company might beat on the top and the bottom line and they nail the stock because they don't like what the CFO said in the conference call. And so it's really, it feels and smells like we're back into a stock picker's market, where we're actively managed should have an advantage if they've got deep and broad research. And so that's one of the things that strikes me, because overall earnings are pretty reasonable. They're not as exuberant on the beats on the top and bottom line as they have been in prior quarters, but they're reasonable and they're consistent with this economy. The other thing that's really notable is companies are seeing from the reaction in other stock prices that if they announce, oh, we're trimming heads over here and we're cutting costs over here, the stock prices go up, sort of no matter what the numbers are, because it looks like management teams are staying really focused to be laser precise in how they're running their business, and the street likes that.
It does, absolutely. We saw that with Meta last year. Just amazing. Carol Schleif, Chief Investment Officer for BMO Family Office. Thanks so much for joining us. Based out there in Minneapolis, St. Paul. I happen to be a St. Paul fan versus Minneapolis. That's just I thought the architecture in St. Paul is really cool.
I've never been to St. Paul.
Is that the airport that has a plane hanging from the ceiling?
I think so. I don't know. I've been to so many airports in the Midwest.
I can't help you out with this one.
Yeah,
I got
great
nothing for
hotel. I forget the name of the hotel that I like staying at in St. Paul. It's just awesome. Really old school. Kind of feel like it was the first thing built in the state of Minnesota back in the day. Pretty cool. S&P 500 up 0.7%. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News for this Bloomberg Business Flash. We are brought to you by IBKR Investment Advisors. Switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. We have the tech mega caps helping lift the S&P 500. Now, the index right now on track for a record close if it keeps to these levels. And also 10-year Treasury yields, they are below 4.1%, just barely, as we wait for a Treasury auction today, the 10 years. S&P 500, 32 points higher, up 0.7%, 49.86 on the index. The Dow Jones Industrial Average up 152 points. The NASDAQ 100 up 151 points. That's up 0.9%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex. You don't have to raise your hand. I can see the red light.
I had the red light on first.
I did. I said Paul and Alex.
Oh, because you end on the red light.
Correct.
I see. It's important that we organize these things.
I'm a professional over here.
That's right. I'm Alex
Professional
Steele,
what?
Paul Sweeney, John Tucker. Bloomberg Intelligence, where we bring you analysis from all our analysts worldwide. They cover like 130 industries, over 2,000 companies. And one of them we're going to drill down into is Tesla. That stock down by 0.3%. A great scoop by Dana Hull and Ed Ludlow on our Bloomberg News team, talking about how staff at Tesla are bracing for potential job cuts. Apparently, managers were asked to affirm whether each of their employees' position is critical. That feels good.
Yeah.
That always feels really great when you hear that. Joining us now is Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. Hey, Steve, what did you make out of the scoop from Bloomberg?
Well, I think, job cuts are never good for the employees, but I think the investors will probably look at it positively because the stock's been down like 12% since their last earnings call and 30% year to date. And that's all because, slowing EV sales, price cuts. So the company needs to do something to address some of the short-term challenges they're facing.
So when I see news like this, it really makes me think, Steve, that maybe they see something fundamental in their business such that they have to look at a big fixed cost like people. What's the company saying these days about where they see, demand?
Well, that's a good question. I think you got two questions there. First of all, fundamentally, they've done a lot of price cutting, in their operations, in the administrative side of things, in their manufacturing. So they're naturally kind of out of, they plucked out all the low-hanging fruits. There's not much to cut anymore other than looking at their human resources, and that's what they're doing at this time. Now, obviously, you don't want to cut, but I think they have to. If you look at Ford's earnings call last night, the market is really brutal. The margins was down was at negative 98% for Ford's EV business. That's worse than their third quarter. So from that, you can see the whole entire EV market is still facing, price cuts, slower demand. And that's, I think that's what Tesla is trying to address for 2024.
Hey, Steve, do we have an idea of when the trough might happen for EVs? Is it just going to take cheaper ones, or is it going to be actually more hybrid and that trough be really pushed out?
I think hybrid is a good kind of fill-in between now and when EVs can take off. Our view is actually around 2026. Because I think that's when cost of manufacturing EVs will come down, with localization of battery production, more EV models out there. And every automaker right now is talking about the second generation of EV vehicles, the third generation of EV vehicles. They were actually designed on a very different platform than the ICE vehicles, the internal combustion engine vehicles, that is supposed to streamline production, cut the number of parts, and hopefully drive costs down to make it more affordable for the consumers.
So it's a 26 story. Will the charging infrastructure also be a 26 story?
Well, no, there are some spending at the moment to increase charging infrastructure. But that's another bottleneck that that the industry is facing. I think, out in the West Coast, out in the East Coast, charging infrastructure are not of a big concern, but Central America is. So that's where the focus is, I think, in the next couple of years to really build up the charging infrastructure in that part of the country.
How many charging units do you have at the Princeton campus at Bloomberg right now?
Oh, it's interesting. If you go out to the parking lot here, you think it's a Tesla dealership out here. There's probably 50, 40 to 50
Do people
charging
have
stations.
the cars? Like, are the Teslas actually being plugged in, or EVs?
Oh yeah. You'll see mostly Tesla. You'll see a couple of Volkswagen, a couple of Volvos, but
because when I was
that's why it's.
When I was at the Princeton campus, Steve, I guess I haven't been there since before the pandemic. Let's call it 5 years. 5 years ago, we had 2. Now you're telling me we have 50. That is a good barometer, I think. Now, I think Bloomberg is usually on the cutting edge of this stuff, but still interesting.
Yeah, and I wonder, did you get the idea that the charging was there, therefore you brought the EVs? Or it's just a clientele that has the EVs? Unfair question, but, what do you think?
That's a good question. It's all about the cost of ownership. I think you're right, Alex. Having the charging stations here, make it convenient for people to charge and really cut their monthly costs. Right, there's no fuel costs anymore with the EVs, but it's all about the cost of ownership.
It's free. The energy's free.
We should be charging you people down there. I'm not going for this.
Nah, they got the solar panels out back. They got
free
the EV
lunch.
They got
Literally
the
free lunch.
It's awesome down there. All right, Steve, thanks so much for joining us.
Great.
Steve Mann, he's the Global Autos Industrials Research. He's down there in Bloomberg in our Princeton office, which is really cool. That was one of the Bloomberg's first offices down there. They had the global data folks. And I don't know how many people we have down there, 3,000, maybe more. Do some awesome work down there, and that's where a lot of the BI folks
And
are
also
there.
all the EVs, apparently.
Apparently all the EVs 50. That's pretty cool. All right, coming up, we're going to have a great conversation. Carlyle CEO Harvey Schwartz is going to speak with Bloomberg Sonali Bassick. So we'll talk about global Wall Street. S&P 500 up 0.8%. The Dow up 0.5%. NASDAQ up 0.9% here. So we'll keep an eye on those earnings. 10-year Treasury 4.09%. Right now, let's get to that big Wall Street discussion. Carlyle CEO Harvey Schwartz. He speaks with Bloomberg Sonali Bassick, talk about the future of Carlyle, the future of private equity from the source. Let's go right now to Sonali Bassick.
Welcome to our Bloomberg television and radio audiences. I'm sitting here with an exclusive interview in Washington, D.C. at Carlyle's headquarters with the CEO of Carlyle, Harvey Schwartz, in his first interview since joining a year ago as CEO. Harvey, today you announced a number of strategic updates to investors. Your stock is up, the most it's been since 2022. What is the biggest change that investors need to know about the future of Carlyle today?
So, great to see you, Sonali. I think the movement in the stock, which you point out, is much more about seeing the momentum in the franchise. So coming into the fourth quarter, the team really came together, and whether it was record FRE, fundraising, the momentum coming into 2024, and then of course, on the call, we outlined some strategic initiatives and for the first time, financial targets for 2024, which, have very significant upward trajectory.
We'll talk about those initiatives, but we can also say you've passed your first year on the job. The grace period is over. What's the biggest?
It's my anniversary yesterday.
Yeah, and what is now? You're looking into year 2, and a lot of people think of this as a make or break year. What is the biggest challenge for you as you enter this year?
So 2023, as a new CEO coming in, it really was about investing time with my teams and spending time with our investing clients around the world. I think I met with over 300 LPs in the first year that I was here. And with respect to my teams, it was really about me getting to know them, but more importantly, them getting to know me. 2024 is really about focus on our priorities, excellence of execution, and more teamwork. If we do those 3 things, we'll exceed our targets for this year.
Part of the changes that you made, these financial initiatives, as well as some strategic updates you've made, means you're going to change the way you pay your deal makers. You've also announced a $1.4 billion buyback plan. How does this change incentives for the people who work at Carlyle and the people who invest in Carlyle?
So when I showed up here, one of the first things the senior investor said is, we would like even more alignment with our investors. So this is about, with our investing clients, this is really about alignment across our stakeholders. So it's our senior investors, our investing clients, and our shareholders. And it's, as I said earlier, it really is a win-win-win, because our investing clients get more alignment with our investors get even more pay for performance, and our shareholders get an increased steady stream of fee-related earnings.
Most investors would recognize it's a tough job. Carlyle's founders, including David Rubenstein, who is a contributor to Bloomberg TV as well, has been famously involved in the succession plan at Carlyle, and they remain large shareholders of the firm. How involved are they in the day-to-day operations? So when I met with the founders before I took this role, I was very clear with them that I wanted them very involved in the business. Carlyle is an iconic brand. They created an amazing culture here. Getting to know this company over the past year has been an extraordinary privilege for me, but having really their history, their connectivity with clients, their investing experience, we'll take as much as we can get at Carlyle. So record fee-related earnings, as you have said, but even in the last year, there was a 36% rise in Carlyle stock. Last year, rivals, Blackstone, Ares were 70% or more. How do you keep up? How do you get Carlyle's stock price to start to match your rivals? So I think about the stock price really as an output. It is about, again, what I said, focus on priorities, deliver performance. If we do all those things, the stock price is going to follow. How do you think about some of these areas that have been very hot-button issues across Wall Street? Take private credit, for example. On one hand, it is a big place for Carlyle to be bringing in new money. You've shown that in the fourth quarter. On the other hand, there are a lot of questions about the industry at large, that a lot of money is flowing in, and whether there's enough opportunities to put that money toward. How do you address those concerns? So I think there's really two questions that have come up around credit. One of them, I think, really relates to systemic risk, and I think a lot of those discussions are sort of misunderstood. If you think about what we do as capital providers and how we provide that capital, and then you have a discussion around systemic risk, it really doesn't have the three core characteristics. We don't have leverage, we don't use significant leverage, there's not concentration risk, and there's not interconnectivity in what we do. So I think the systemic risk discussion, that's a bit overblown. In terms of deploying credit, it's our responsibility, first and foremost, to our investing clients to deploy that credit in the most thoughtful way possible. And that's what having 20-plus years experience in the credit business. There is a risk of a bubble? I think whenever you see a lot of capital moving into a space, you have to worry about, at the margin, how that distorts the opportunity set. But that's where the investing teams really have to do their best work. They have to pick their credits, they have to deploy that capital, and they have to perform. You know, we're sitting here on a week, too, where you're seeing fears about regional banking come up once again in the market. You're seeing the issues over at New York Community Bank and the downgrades that it's been facing. When you think about the role of private capital, where Carlyle fits into the story, how much can private capital really start to jump into the problems of the regional banking system? So I think as capital providers, whether it's in our private equity platform, credit, our solutions business, I think this capital can be incredibly valuable and has proven to be valuable in terms of solving economic problems. And so I think when you think about banking crisis or a banking disruption, the best way to address that is with the most efficient cost of capital. And if Carlyle can be a provider of that capital, I think we should put that capital to work on behalf of our clients. Well, some of the areas, too, are kind of choppier. Let's say commercial real estate, for example. There are a lot of fears that the commercial real estate sector could really be facing a significant crisis, particularly in the New York area. Do you share those concerns? So one of the very fortunate things that I inherited when I showed up at Carlyle is one of the best real estate investing teams in the world. Their performance over 20 years is truly extraordinary. When I talked to them about commercial real estate, they really started backing away from office many, many years ago. We don't see it as a sector where yet we see real opportunity. So I think there's going to be challenges, but I think this plays out over many, many years because in some respects, we can see this problem.
But it's a problem that'll have to be digested by the markets over a number of years.
Yeah, let's get a little macro here, because part of this problem is being caused on the heels of higher interest rates. And you have a market now that still expects more than 5 rate cuts before the January FOMC meeting of next year. Do you believe that those 5 rate cuts will come to fruition?
So we have a pretty unique perspective on this, because across our portfolio companies, we have in excess of 1 million employees, and we see the data and the performance. I would say that if you step back and you think about historic Fed behavior, the Fed typically either is fine-tuning or cutting dramatically or raising dramatically. And when we look at the data from our portfolio companies, and then you look at strong GDP, unemployment numbers that are quite attractive, when you see inflation has really stopped materially and paused at this stage, I don't think we should be rooting for 5 or 8 rate cuts. I think that would suggest an environment that actually requires a lot of attention from the Fed. I think we should be hoping for fine-tuning, because I think the economy is in better shape than people are giving credit for, and I think the Fed's done a fantastic job navigating this.
So what is a more realistic view of where rates go?
In our model, we would expect the base case to be 2 or 3 cuts. The Fed, we expect to be very data sensitive. We're watching this closely also. But again, my crystal ball may be as good as yours. So we'll see what happens. Markets are hard to predict.
What's the risk then that we tip over from a soft landing or even no landing into a recession? What would cause the tides to turn?
I think you could see if you had an unexpected market disruption, geopolitical event. But remember, the Fed has communicated to us that they're watching this data very carefully. And so hoping for multiple rate cuts, I think it's a little bit of a recency bias. I think it's people really saying, oh, I really enjoyed that QE that we're experiencing. I think as market participants, we should want a normalized cost of capital. And if we can get there through this process, I think it'd be an extraordinary outcome. And I think it'd actually be, I think it'd be great for business opportunities. I think it'd be really good for Carlyle, and I think it'd be great for our investing clients. I think we create a lot of alpha.
I'm curious about your view of the world. We're sitting here in Washington, D.C. today. I have a few D.C. questions for you. Before we get there, you do have a large presence internationally as well, particularly when it comes to China, at a time where there are a lot of questions about the world's second largest economy, the strength of the economy there, and its relationship with Washington, D.C. and the United States. How do you view those challenges, and how do you navigate them as an investor?
So we represent investors all over the world. They have different requirements. Some of those will look at China and they'll say, you know, the risk profile doesn't look like it fits our characters. Many of my clients around the world, in touring the world last year, they really like the risk reward in China. And you know, you bring up China, it got a lot of attention because we sold our position in McDonald's. I'm sure you saw it. This was a tremendous return over a number of years. And the one thing I'll say about that, because it really highlights the power of our private equity franchise, you know, people ask me this question all the time, well, on higher rates, what does that mean for business? When you actually look at that transaction, it was a near 7 times return for our investors in China, just exited right in this environment, and roughly 80% of the value creation came just from operational enhancements. So it's really what we do. It's about picking the right partner, being in China made sense, and actually executing the business. So I think there's opportunities.
What about the opportunities here at home? There have been a large U.S. investors, a lot of big names sounding alarms about what's happening here, not about the economy, but about the sustainability of what we're spending as a country, the debt load and the deficit. How do you view that from where you're sitting, and do you think it could spiral into a bigger problem?
So I think these are all legitimate concerns. We tend to lament a lot of things in the United States. I think I'll tell you, when I traveled around the world last year in a number of geographies, I was told by our investing clients they felt a bit over-allocated to the United States, and they actually said they're going to keep allocating more to the United States. I wouldn't bet against the United States.
Well, what about that concern embedded with the dysfunction you're seeing in Congress alone? How do you see kind of this gridlock impacting investors throughout the year?
So, you know, we're in an election year, and I was just talking to one of our chief economists, Jason Thomas. We were having a discussion about this just last week. And I think the S&P 500 has gone through 23 election cycles. In 23 election cycles, roughly 80+% of the time, Democrat, Republican, the S&P 500 has gone up. I'd like to see us get through an election cycle, and I'd like to see everyone in Washington really start to come together, because we do have complex problems, and coming together is the way we're going to solve them.
Well, with the constant threat here of government shutdowns, for example, do you think that the road ahead this year could be bumpy, particularly as we head through to the election?
If it's been like the ones I just mentioned for the 23 elections since the S&P 500, I think it's going to be good for markets. I don't think it's great when our politicians play ping pong with things like the debt ceiling and everything else. I think we should just focus on the business of the government, but I'm not a politician.
The election itself. Obviously, this is a very unique election with two leading contenders having served in office recently. How do you see this really playing out? Both candidates, both leading candidates in the Democratic and Republican Party have low approval ratings. How do you think about this dynamic in the C-suite and the risks that it poses into 2025?
So, Carlisle, we've been doing this for a very, very long time. We've been through complicated elections. We've been through surprise elections. I think we'll get through this election, and as I said, we'll focus on the business and the priorities of the day.
Priorities of today. We've kind of started this conversation talking about Carlisle, the future of Carlisle. By the time you're done leading Carlisle, what ways will you have transformed the firm?
Well, I'm not thinking about being done. I think we're just getting started. I couldn't be prouder of my team this year, the way they really came together. You saw it in all the growth, and you see it in the momentum coming into this year. Again, this is really, as I said, if we focus on our investing clients, we focus on performance, Carlisle will continue to grow, and we will be an incredibly important capital provider to people benefiting from that capital.
With all of these changes, it begs the question, too, private credit, wealth channels, what's the future of traditional private equity? Especially under a higher interest rate regime, as you've mentioned.
So, you and I have chatted about this before. I don't generally make any sort of long-dated predictions. I think the role of private equity and private capital will only grow over the next several years. The number of companies that will want to stay private, the wealth accumulation in the world, the actual wealth that will move into this sector, often referred to as the democratization of the asset class, the tailwinds in the industry. And one of the great appeals for me actually coming in and thinking about, can I really have the impact I want to have at Carlisle, is about the trajectory of this industry. I think it's early days for private capital managers, and I think we're all on a pretty steady growth path.
Last word here, it's interesting. You're talking about these share buybacks. You're talking about also the changes you're making at the firm. Analyst on the call earlier was almost asking, are you giving back too much money? How are you going to keep investing back into the firm? How are you going to keep investing back into the firm?
So in terms of how we think about capital allocation, today was all about defining the flexibility, acknowledging first and foremost that we think the enterprise value isn't represented. And so if we think that is the best marginal deployment of capital, we'll put it back to the shareholder. We're not going to sacrifice growth opportunities. And I don't want to make it too technical, but it really just is about the efficient frontier and efficiently allocating that capital. If we think the best opportunity is in growth, where we see enormous opportunity, we'll do it. If we think the capital flexibility provides us the opportunity to return it to shareholders, we'll do it. But the balance sheet is strong, and we can do both things.
Harvey, thank you so much for your time. That is Harvey Schwartz, the CEO of Carlisle, just off of his first year on the job for Bloomberg Television and radio audiences.
Great stuff there. Shonali Basak interviewing Harvey Schwartz, the CEO of Carlisle Group, and he is, I just found out, a proud graduate of the State University of New Jersey, Rutgers. How cool is that? So Carlisle Group, I mean, just doing phenomenally well here, and it's what's unique about them from my perspective is they're based down in Washington D.C. That's kind of the genetic makeup of Carlisle. A lot of Washington folks, so they got that whole government angle wired off, and so they've done a phenomenal thing. So good to hear from Mr. Schwartz as the CEO of Carlisle Group. All right, we're going to go right to the regional banks, but first, are we going to talk to John Tucker first?
Yeah, we are.
All right, let's get a Bloomberg Business Flash. You want to do that?
Oh, a business flash. Okay. Yeah, we can do that.
Do it.
All right. Right now, the major averages all in the green with the S&P 500 knocking on the door of 5,049.89 in the index. Even if it doesn't reach that level, it is still on course to set another record close, up 35 points. That's up, why am I talking like this? Up 0.7%. Dow Jones Industrial Average right now, that is up 164 points. That's a rise of 0.4%. And the NASDAQ 100, that is a whopping 1% higher right now, with some of the mega caps in the lead, up 192 points. Also, the 10-year worth focusing on today, down 1 basis point, 4.08%. There is a 10-year Treasury auction, and before you start yawning, That's important because if there is a good take-up, plenty of demand for the benchmark yield and debt, that could bode well for both the bond and the stock market.
I'm actually
as well.
into this auction, by the way.
Really?
Yes, I am. I'm excited about it.
Good.
So, you didn't glaze my eyes over on
You
that.
really need to get out more.
Anyway. Well, that is true.
We check the markets for you all day long right here on Bloomberg Radio. And I'm John Tucker. That is your Bloomberg Business Flash, Alex and Paul.
All right,
both
John Tucker.
turn your lights on at the same time, so I don't know.
Perfect stuff, John. Appreciate it. Let's go to Herman Chen here. He's the senior analyst covering the regional banks. Herman, New York Community Bank, that's the story of, I guess, the last several days. What's the current status of that? Is that something that bank investors in general have to worry about, regional banks in this country?
Sure. I think it's definitely brought to the forefront worries about commercial real estate in particular, but really New York Community's issues are a bit idiosyncratic because they just crossed over that $100 billion threshold that requires tougher regulatory scrutiny. And New York Community is also the dominant lender in the rent-regulated apartment lending area here in New York, so not much read across to other regionals.
Well, we also had a headline that they want to sell some of their RV loans and offload some mortgage risk. Are they going to be the buyers for that?
Right, so that's going to be an issue for them.
Or I guess the buyers at the right price.
Buyers at the right price. So for New York Community, what these two actions are really a bid to improve their capital ratios. They've talked about lifting their CET1 ratio to 10% by the end of the year, which would be more in line with their larger regional banking peers. And so the synthetic transaction to add insurance on their residential mortgage loans and offload some RV loans is designed to potentially do that.
RV loans. Now, these are recreational vehicle loans. John Tucker thought there was some technical, arcane term for these are for recreational.
To be fair to John Tucker, that was me.
Okay.
I was the one who was like, is this a specialized sort of loan?
So, is that a thing?
Yeah, so it's a thing that some regional banks actually do, and it's a lucrative business. You can think of it as sort of like an auto loan, but just for RVs. And banks like M&T and Bank OZK.
Bank of the Ozarks.
Yeah, Bank of the
Big
Ozarks.
RV country down there.
These are RV lenders. Yeah.
Well, also remember that RVs were super hot in 2020. Everyone wanted them. You couldn't make them fast enough because that was the only vacation you could have. Get in your RV, go around. So
that's right.
What's going to be
explore the open road?
Exactly. What's going to be next for this company? Because you could make an argument that they're doing everything right, and I'm putting that in quotes, in terms of updating investors, getting their books in order,
right,
etc. So what do they do now?
They're trying to control the narrative, but the market's saying something else entirely, where the market's concerned that even though liquidity is in a pretty good shape and deposits are actually up but since the end of the year, are they going to be able to generate enough earnings to meet their capital ratios, and how are they going to fare in the upcoming stress test? When they did that, if you step back and when you look at what they did after they announced the signature transaction last year, when they were viewed as a savior, they could have been, I guess, maybe a bit more aggressive in building up their capital and liquidity back then, so they're not in a pickle now, but that's really spilled milk at this point.
So one of the themes that I'm still in the back of my mind, if I were bank investors, I just don't know the magnitude of some of these commercial real estate exposures. I believe in the past you've said for most lenders it's not that big a deal. Is that right?
Well, we're going to talk specifically about office commercial real estate, where that's right, really the potential boogeyman here. On average, across our research coverage, which covers the largest 19, 20 regional banks, it's 2% of their total loan book. So it's actually really small and manageable. And and then on top of that, you have pretty conservative underwriting, and they know this is a risk, and the regulators know this is a risk. So the banks have already started to build up reserves to protect against potential losses. So put that all together, it just seems like it's going to be a manageable issue. But you're going to see losses eventually.
So can this bank stay in business?
That's going to be an open question. They've tried to put a very encouraging view out there on their earnings, on their management call earlier this morning, talking about the strength of the deposit franchise, and you're not seeing deposits flow out of the branches, and they have a boost to liquidity. So what they need is time, and it remains to be seen if the market's going to give them time to build up their capital.
Right.
I want some M&A. I want some business. I want to come in here every Monday morning and see company A, bank A buying bank B.
But that's what they did, and look what they're in now.
That's true. So, be careful. Be careful what you wish for. Be careful what you wish for. Are we going to see some of that? Do you think?
You know, this whole issue surrounding your community where they came in, helped out the FDIC and the regulators, and really helped out the banking system by taking over Signature. And now they're in this pickle where they have to adhere to these tougher regulations, clearing that 100 billion mark. I don't think any other bank that's going to be in this same situation wants to jump into that same scenario.
Can I ask